hard landing is very likely because the labor market has gotten too tight.
This is an environment where the bond market vigilantes are back.
You're seeing spreads stay wide and stay sticky.
The Fed is, with the jobs report, is really indicating that they'll probably continue on hiking in a more aggressive fashion.
I think there's worse to come for the market, unfortunately.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance. I'm Jonathan Ferro. Together this morning with Greg Peters of PGIM. Lisa Abramowicz coming up a little bit later with some special guests, including Apollo's Jim Zalta. Looking forward to that. Futures right now down about 1% on the S&P 500. Greg, perfect timing because we've got a lot to talk about in this bond market. The Bank of England, busy the last couple of days. What do you make of what we've seen this morning?
Well, I see the Bank of England continuing to have their back against the wall. They have no choice in the matter. They're trying to deal with this political situation that's reverberating across the system. LDI is the new acronym du jour. And so I just think they're stuck, and you're setting up for a showdown. I think that's the story. You're setting up for a showdown as you basically have the program ending, QT beginning again, and the budget being due all on the same day.
Well, as you say,
right after the Fed.
We've got a date for the showdown, haven't we? October 14th is the first date. Greg's going to be with us through the hour on a lot of this. Greg, this is what they said in their statement. The bank plans to end these operations and cease all gilt purchases on Friday, the 14th of October. Do you expect to wake up Monday morning and see this continue?
You know, anytime you draw a line in the sand, that's generally a bad idea, right? It's the Maginot line I think they're drawing. And so I really worry about that as the markets will test them. And I think most investors believe that this is a program that has to continue, whether they state otherwise or not.
Some tension in this bond market. Equity futures, as I say, down about 1 full percentage point. I'll whip through the price action for you briefly. The Treasury market, the cash Treasury market reopening in America with yields higher. Equities down, yields up. How many times have we talked about that? Equities down 1% and yields look a little something like this on a 10-year Treasury. On a 10-year right now on my screen, yields higher by 7 basis points. Up to about 395.11 on a US 10-year. In the FX market, euro dollar unchanged at 96.99. Call it 97. Crude down by about 2.6%, $88 and about 74 cents. Greg, I've got to pick up on the move in euro dollar. We're not going anywhere this morning, but there's 2 points of tension in the global bond market. One's the gilt market, the other's Italy. Yesterday, briefly, through 250, Italy over Germany. Then we put out this story about possibly a mutualization of debt, the effort to offset some of the pain on the energy front. Can you tell me how much tension you're seeing play out in the European bond market?
Not a tremendous amount as of yet. I mean, that is the tension point, that story that was kind of about yesterday. The Germans tried to dismiss that at the same time, threw some cold water on that, Jonathan, I'm sorry to say. But ultimately, it just shows with higher rates, fiscal issues, the ECB has the same challenges as the BOE. And they have to keep together. They have to keep funding liquid across all the different jurisdictions across Europe.
You
no
mentioned
easy
the
task.
acronym in the UK. We can talk about the acronym in Europe. TPI, Transmission Protection Instrument, not activated right now. Do you expect that to be activated pretty soon?
I think, once again, you draw a line in the sand, the markets will test it. And so I think as we enter the cold winter months, I think that pressure will likely ramp up, and you'll see that get activated one way, shape, or form. Details matter, and so we're all wondering what that means, Jonathan. And so, once again, the markets will test it, as they always do.
George Concalves joining us now, the head of US macro strategy at MUFG. George, I'd love your thoughts on the UK first of all. I think one conversation we've all had over the last few weeks is how unique these problems are to the UK, the potential for spillover from the UK to the global bond market. Can you walk us through, George, those two particular standpoints?
Hey, good morning, John. Yes, definitely the bond vigilantes have shown up first in the UK market, but with it, they kind of dragged up all global rates. I think that's the big issue here, that we've had years for this QE policy globally set and anchored rates globally. U.S. markets benefited from the back end of it, and now, we're clearly going to see what happens in the UK. But I think, for the U.S., the Fed has a similar problem too. I mean, we've had 2 attempts in the last 3-4 months of trying to call the pivot the pivot team has 0, and the roaring bears are 2 right now. And I think that the bears are going to win at least for the next couple of weeks.
George, in Japan this morning, we put out the headline about 40 minutes ago. The 10-year bond in Japan hasn't traded for 3 days for the first time since 1999. George, can you even call some of these bond markets?
They definitely need to open up and get more liquidity, that's for sure. And I do think that that's just another example of just how when you get so involved, intertwined in your markets, it's hard to kind of pull yourself out.
Hey George, it's Greg. Good to see you.
Right.
How do you see the correlations playing out over the near term? So one of the challenges that we have in the bond market is that it's a bond market of one. So before this all kind of started, you'd have allocations in one market versus the other. Today it seems like one. How do you see that playing out over the near term, and do you see that breaking?
I think at some point it does break, but I think the Fed is leading the charge. But although I think we've seen a global rise in short rates, at some point there's going to be a kind of a splitting off between the central banks around the world, and the Fed probably keeps going forward, and the BOE and the ECB is going to have to kind of run out of fuel, and they can't really keep going further. So I think the correlations will probably shift further to the back end, the 10-year sector plus, where you have real risks of big bear steepenings over the course of the fourth quarter.
And then how do you see the ECB being challenged over the winter? Jonathan and I were talking about it right before you got on. Do you see that being a real part of the risk factor heading into the winter?
Well, look, if there's any central bank that can actually turn, maybe not dovish, but could probably pivot sooner, is the ECB, because they're going to have the challenge between really thinking about growth versus inflation and that fight. And considering that growth is really going to decelerate, it has been decelerating in Europe, I think the ECB would be the one to kind of take a pause first. Doesn't mean that they're done tightening, but it could be like a 2-stage tightening cycle where they have to get through the winter and then pick up the pieces in the spring.
We've all got to talk about trade-offs then. Vice Chair Brainerd came out yesterday with a long speech. I read it for us so you don't have to, George. I'm sure you did anyway. This is what Brainerd had to say. Greg, I'd love your thoughts on this as well. In this environment, a sharp decrease in risk sentiment or other risk event that may be difficult to anticipate could be amplified, especially given fragile liquidity in core financial markets. In some countries, she went on to say, the realization of these risks could pose challenging trade-offs for policy. What are the policy trade-offs if you're doing this right now? Is this a decision between getting inflation down and maintaining financial stability? Is it one or the other? Can you do both at the same time, Greg?
I think it's really hard to do both. And I think what the market has missed throughout the course of this year is that the Fed and central banks globally are fighting inflation. This is very different than what we've seen over the past many decades. And I think financial stability has also been kind of thrown in for quota the Fed put and other types of things. So like functioning markets is what matters to central bankers, not that prices are lower necessarily, right? And so I think, this is just another kind of spin on traders and investors hoping to get bailed out by central banks.
Reminds me of 2018 then. What was the difference between now and 2018? Because last time they backed off and said it was about functioning markets, the markets weren't functioning. What's the difference between now and what happened in late 2018?
I don't know. That's a good question. I mean, it's all blurred. 2018 sounds like three lifetimes ago.
3 decades ago.
But I think, 2020 is a better example, actually, March of 2020. The reason why the Fed stepped in initially was because the markets were completely broken. So you could not trade U.S. Treasuries, and we're not quite there yet. So liquidity is impinged in the Treasury market, absolutely. We just talked about JGBs, not trading for 2 straight days. That seems to be common practice there now. So I think central banks are focused on function, not pricing.
George, do we have a market functioning issue that this Fed needs to respond to anytime soon?
I mean, look, in the U.S. markets, they're still functioning, but liquidity is kind of dear, and and sizing of trades are probably going to keep getting scaled down. We're also heading into the end of the year, and after such a tough year that we've had, you would expect people to pare down risk anyway. And balance sheets are scarce. And so I think we are at the kind of toughest spot, in the year. So if liquidity risks were to get worse here, I think, yes, it would matter. But at the end of the day, which markets does the Fed really care about? It's really the bond market. It's the foundation of everything, the repo markets. And the Fed has a lot of tools they put in place since both the COVID crisis and financial crisis. So I think they'd probably let the first lines of defense hold and see how that would work before they would actually pivot anytime soon.
One last question for you both on this, and George, first to you. Is the 10-year a buy again? Every time we get close to 4%, we got to that level, then backed away. We're kind of getting close to that level again, up 7 basis points today and back to 395.
Look, I mean, I think we're at this tough spot. I mean, I'm more concerned about equities than I am about bonds at this point. I think that bonds could benefit from one last flight to quality type move. I don't think it kind of pivots the Fed, but if we have another kind of equity move down 5-10% in the coming weeks, and bonds will rally on that, and then the question is, like, does the Fed blink? I don't think they will.
Hey, George, thank you, sir. As always, George Concalves there of MUFG. Greg, your thoughts on that? A buy leaning a little bit into the 10-year, into the 30-year space?
Well, so I think we're closer to the end than the beginning, to state the obvious.
Yeah.
And so above 4%, and where real rates are, does present value. Will you be able to time it? Absolutely not. I think you need to see the cresting of the front end. I think you need to see rhetoric change, all these types of things. But you are getting close to it. And so I see a lot more value, let's say, in the U.S. Treasury market than I do in some of the credit markets.
So on mornings like this morning, with the screens we've got in front of us right now, your Bloomberg, my Bloomberg, what are you doing on a morning like this morning, Greg?
Well, still early, Jonathan. I'm still watching it, but no, I mean, you have to take a longer-term view in this market. I think trading this market is incredibly difficult. So yeah, you modulate here and there, but you have to have a North Star view, and our North Star view is that there is value, but we're not getting kind of chopped up and just brought in. So I think you have to be disciplined. You can't just kind of watch the screens as it just makes you mad.
395.31. Watching the screens and getting mad this morning. Yields higher by 7 basis points. Greg Peters of PGIM sticking with us through the hour. In the next hour, we'll catch up with Gargi Chowdhury of BlackRock. We'll also be catching up with Mohammed Al-Arian, who will be with us through the 7 o'clock hour to break down some of these issues. In just a moment, we'll hear from Maria Tadeo over in Brussels on the potential, the possibility for maybe a joint jet effort in Europe, and potentially a lot more cold water to come from the Germans. From New York City this morning, good morning. Equity futures are lower by about 1 full percentage point. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A group of 7 leaders are scheduled today to hold a call during which Russia's strikes on civilian targets are set to top the agenda. Russian leader Vladimir Putin has said the fresh assault was a retaliation for explosions on a multi-billion-dollar bridge connecting Russia to Crimea. Ukraine has not claimed responsibility for that incident. We traded near the highest level in more than 3 months as Russian President Vladimir Putin threatened more missile strikes across Ukraine. The escalation has sparked more fears that harvest and transport in the country will be cut even further. The agreement over the Black Sea export corridor comes up for renewal next month. The heads of the IMF and World Bank are warning of rising risk of global recession. IMF Managing Director Kristalina Georgieva says higher interest rates are adding to debt pressures on developing nations. She says about a third of the world economy will enter recession this year or next. And Bloomberg has learned the UK is pushing ahead with plans to set a cap on the revenues of renewable power producers. Government officials held talks with energy companies on a mechanism similar to the one proposed in the EU. The move would limit revenues and channel the funds to help struggling consumers. And more allegations in the Elon Musk and Twitter battle. Bloomberg has learned that just before the billionaire revived his proposal to buy the social media company, he accused Twitter of ordering a whistleblower to destroy evidence. According to court filings, Peter Zatko said he burned 10 handwritten notebooks and deleted 100 computer files at the request of managers as part of a $7.8 million severance package. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
There's the risk and the real danger of a world recession next year. The advanced economies are slowing in Europe. The debt levels for the developing countries are getting more and more burdensome. The rise in interest rates puts added weight on it. And inflation is still a major problem for everyone, but especially for the poor.
David Malpass there, the World Bank president, alongside the IMF managing director, Kristalina Georgieva, in the last 24 hours. Alongside me through this hour, Greg Peters of PGIM. I'm Jonathan Ferro. Greg, when the IMF and the World Bank start saying it, do you start to get the itch to lean the other way?
Yeah, well, history definitely tells you that
right?
That's the case. It's very concurrent forecasting, I think. But it just speaks to just how much negativity. Like, this is a recession that's been talked about for the past 9 months, and the data aren't quite there yet. So I think we have another 6 months before things start to play out potentially. So this has been what we call a slow-moving train wreck, and the IMF and World Bank just getting on board is just testament to that.
A slow-moving train wreck over in Italy as well. 10-year yield in Italy this morning up another 12 basis points, back to 474. Big round trip in the last 24 hours. Our story in the last day or so that Germany is going to back joint EU debt for loans to ease the energy crisis got a little bit of pushback from the German government in the last day or so, the last 12 hours. Maria Tadeo joins us now, Bloomberg Europe correspondent out of Brussels. Maria, walk me through the German response to our story suggesting that they're ready to back joint EU debt for loans to ease the energy situation.
Well, Jonathan, you have one source that doesn't go on the record and says the German government is not aware of this plan. But I think you need to take a step back and see how the German government operates at this stage. This is a three-party coalition. Of course, a Bloomberg story mentioned that is Olaf Scholz, the German chancellor, who had, well, a change of heart after he met with European leaders last week. What I can tell you is that for a week, something has been cooking in the behind the scenes across Europe. There was a lot of pushback to the initial 200 billion euro stimulus plan that Germany put out. In the Eurogroup, you could hear a number of countries very openly saying we will need some type of joint response. Otherwise, this is going to be each nation to their own devices, and therefore there's going to be a problem when it comes to the fiscal capacity. And then when the German chancellor met with European leaders last week, well, he heard the same message. There was also a lot of criticism that Germany did not coordinate well, that Germany did not have a lot of communication. What I would say, though, is that we're at a stage where this is an open debate, where there's an actual behind-the-scenes tension in terms of how to respond to the energy crisis and do it jointly. This is not going to go away. And if you ask me, the choreography from now on will be listen to energy ministers today, wait for the European Commission to put something on paper, and then this time next week, European leaders will have to decide on something, whether this is joint debt, whether it's a price cap. I think that remains to be seen. But there is a debate.
Well, let's talk about the approach to that debate. Is it over loans or grants?
This we have to make very clear, because we've never talked about a recovery fund. If you go back in time, and again, you have to allow me 30 seconds, a very technical talk here. But if you go back to 2020, this was the recovery fund. It was the wow moment for the European Union. They went jointly AAA rated debt to the market and then distributed that in grants and loans. What we're talking about here is a plan that came before the recovery fund that was known as the SURE, but everyone forgot about it because it was eclipsed by the big fund. Now, the idea here is that as the EU, you go to the market, AAA rated, you lock better funding costs, and then you get that to member states, but they will have to pay it back. The only difference is that if you're Italy, you probably want to do it at that rate and not have to do it independently on the market, because you're not going to be able to lock such an advantageous rate. That is where the debate is at. Nobody's talking about a recovery fund 2.0. We have to be very precise about this.
Maria, wonderful to catch up with you. Maria Tadeo out of Brussels on the latest effort. Greg, does that get it done for you? Is that enough to put a lid on things over in Italy if this gets finalised?
It helps, absolutely helps. It definitely allays a major fear that the markets have, where the ECB will lose control and the ability of these peripheral countries to fund themselves at a time where they need the funding. So I think this absolutely helps. And the closer you get Europe together as a fiscal union, the better off we are.
How do you compare what's happening now to, say, 10 years ago, when the epicenter, the catalyst for the crisis, was on the periphery, and now arguably the epicenter of this is in Germany? Greg, that's quite a change.
It is a change, and I think it matters, and we can kind of think cynically about it, of course, but what it is a process that I think pulls the core to the periphery instead of the other way around, and maybe just perhaps Germany seeing the value of having a more fiscal union and an aligned European Union.
Does that present opportunity in Europe in a way that perhaps there wasn't an opportunity before we got the whatever it takes moment with Draghi?
I think so. I think so. I mean, if you go back, Europe was trading as a single marketplace. That obviously blew apart. And it continues to be quite fractured. But I think it takes less pressure off just call Italy and puts more pressure on Germany. And all else equal, that's not such a bad thing.
So is 475 a good thing on a 10-year for you and a team? Is that something you'd buy?
For Germany?
For Italy?
No, I know.
For Germany, I think you take 475 in a heartbeat. For Italy right now?
Once again, I think it's too early, right? The challenge that I think investors have is the extreme volatility. And so we're focused on gilts, of course, right?
Sure.
When it swung 100 basis points in a day. But it's happening all over. And so it's hard to really put a stake in the ground. So the vol is so extreme, I think it keeps capital out. So you need to dampen the vol, which is what I think these programs do and central banks try to do. And then investors start to enter the fray.
I've been so surprised by how ambitious the ECB has been in the last couple of months. We're having another conversation about a 75 basis point hike. And Greg, if I go back to the conversations we'd have in the pandemic, I think if you'd asked me, I was pretty open about it at the time. I was seriously sitting there thinking we could go another full cycle without a rate hike from the ECB. I wasn't alone. Other people were saying the same thing. And here we are talking about 75 again at the end of this month. Do you think that's doable without causing some real issues?
I think it is. And I think the ECB has been allowed to get out of the trap, right? So look at what's going on in Japan, right? So, the BOJ is stuck, right? And they're stuck as far as the eye can see. And I think that has clear implications. So I think the ECB is using this as an opportunity to normalize rates, as I think, history will shine a very unfavorable light on negative rates. And I think they're trying to get as much room as they can. So when things do slow, they can cut again.
Are we leaving behind this era? There are some people who believe we're just going to return to it in a couple of years' time. Do you think we are firmly leaving behind this era?
I think so. I think we're moving out of this central bank dominant phase, that era. Like I said, I think history is going to look back on that and go, God, that's a really bad idea. You're destroying savers. You're destroying insurance companies. Look at the fallout on the LDI side, right? That's just an artifact of the change in policy and how difficult they had it over the past number of years.
Let's hope we can get to a better destination. It's certainly painful making the transition right now. Andrew Hollenhorst of Citi is going to be joining us shortly. Andrew's looking for another 75 basis point hike from this Federal Reserve at the start of November. Coming up, Andrew Hollenhorst of Citi alongside Anne-Marie Hordern, AMH out of DC. In the next hour, we'll catch up with Mohammed Al-Arian right here around the table in New York City. Yields up, stocks down. How many times have we said that? Live from New York City this morning. Good morning to you all. Here's the price action on the S&P 500. On the Nasdaq, we are lower, negative, down by 0.9 on the S&P. On the Nasdaq 100, we're down by 0.9% also. Equities down, yields higher, 2s, 10s and 30s, shaping up as follows. On a 10-year, up by 6 basis points, approaching 4% all over again at 394.49 on a 10-year maturity. At the front end on a 2-year, not far off the highs of the year, up another basis point. Let's call it 132, or rather call it 432 before you get too excited. 432 at 431.83. Yields are higher. The euro looks something like this. Euro dollar clinging on, holding on unchanged to about 97.05, unchanged going into the ECB later this month, with some calls for a 75 basis point hike from the European Central Bank. The ECB speak still to come. The Fed speak front and center in the last 24 hours. We heard from the Chicago Fed President, Charles Evans. Take a listen to what he had to say.
The Federal Reserve is committed to returning inflation to its 2% average goal. To do so, I expect we will need to raise rates further and then to hold that stance for a while. Of course, the exact path forward for policy will depend on the evolution of the economy and risks to the outlook.
Those comments got some people excited that just maybe a pivot was around the corner. Goldman Sachs pushing back this morning. The team over there writing the following: with gasoline prices on the rise until a broader set of macro data suggests more material weakness in the economy, they go on to say, we would generally lean against markets' dovish repricing of the Fed. Greg, this drives you nuts, doesn't it? I mean, how many times have we done this in the last 3 or 4 months?
It does. Hope springs eternal, Jonathan, right? And so I think the markets have been looking for any window of change and pivot, and I just don't think it's there. I think the most important point in that speech was average inflation. It's not 2%, it's average. And so I think that gives you more room. And so I don't think they're going to be completely dogmatic to get to 2%. It has to be 2%-ish, so maybe a 2 handle. But the average thing is what really I picked up on.
They've done a lot in 6 months. And Vice Chair Brainerd, in her speech yesterday, reflected on some of that, the 300 basis points of tightening in 6 months. And she went through a list of things. The 2-year through 4% for the first time since 2007. The 10-year near the highest levels in a decade. Mortgage rates have doubled this year. They reflected on what's happened with the dollar. The Fed's broad dollar index appreciated 11%. They believe there's a lot of tightening in the pipeline, Greg, and I just wonder the risk that they've already overdone it. Do you think there is a risk they've already overdone it?
I think so. I mean, the Fed believes that it's a financially driven economy, so there's a much more immediate impact on rate hikes than what they've experienced in the past. And so time will tell whether that's true or not, but they've done a lot already. You're starting to see fractures in the mortgage market and the housing market. And so my suspicion is that they want to get, another 100 in, let's call it, just for good measure. And then they'll reset and see where things shake out.
Citi thinks there's 75 of that coming at the next meeting. Andrew Hollenhorst of Citi joins us right now, the chief US economist. Andrew, let's start there. Why another 75 for you in the next month?
So I think it really goes back to what you were just discussing, that the Fed has two issues here. One is an economic fundamentals issue. And that's right. There's been a lot of progress in terms of tightening financial conditions, probably further to go. A lot of that's already priced in. But then they also separately have a communication issue. And I think that's what they're managing. And that's what you see in some of those comments from Evans and from Brainerd, where, yes, of course, as interest rates get higher and you get into a range that may be more restrictive, you start thinking about, should you slow down? Should you pause? The issue is, from a communications perspective, how do you explain to markets and the public that you still have resolve in fighting inflation if you're slowing down rate hikes or you're pausing rate hikes? And it ultimately goes back to the data. Is the data going to give the Fed flexibility to do that? Will we see CPI slowing down? Will we see a job market that's loosening? So I think that's what they're really watching now.
Are we seeing any of those things, of the two things that you mentioned?
I think you can argue in labor markets, we maybe saw the first sign of some loosening, and you heard Vice Chair Brainerd talk about this yesterday, where we had job openings come off meaningfully. So we had a ratio of about 2 job openings to every 1 unemployed individual. Historically, normal ratio would be maybe 1.1. That came down now to 1.7 openings to every 1 unemployed individual. So it's moving in the right direction for the Fed if they want to see some of that excess demand coming off. However, the level 1.7 openings to every 1 unemployed individual, I mean, just intuitively, that's a lot of excess demand for labor that's still out there.
And Andrew, we have a big release this week, CPI. Is there a level that you think shakes markets' confidence one way or the other? So consensus, I think, is 8.1 annualized. Is there one number, or do we need several numbers of a certain trend to really kind of move Fed rhetoric?
Yeah. Hi, Greg. I think it really is going to come down to, where does that core monthly inflation number come in? That's what we saw last month, where it was a stronger core reading. And Brainerd talked about this yesterday. Core goods in particular stayed strong. There's a pretty broad consensus that core goods prices should be coming off. Until recently, at least, we had commodity prices that were moving lower, used car prices that look like they should move lower. We've seen that in the wholesale prices. So we're really watching that core goods component in the release to see if that slows down. Right now, we look at that core CPI inflation month on month. We have that at Citi at 0.5% month on month, consensus around 0.4% month on month. If you saw that slow down to a 0.2 or even a 0.3, that would be a signal to markets that maybe you're getting some easing in price pressure. I think, though, the risks are actually still to the upside, that maybe we'll see that 0.4 or even 0.5 like we're projecting.
Andrew, I picked up on that quote as well from Vice Chair Brainerd. She said there was ample room for margin recompression to help reduce goods inflation as demand cools, supply constraints ease and inventories increase. Andrew, tell me the part of inflation that's actually going to be stickier, and then Greg and I can have a conversation about what that means for corporate profits.
So I would take this back to the labor market. I think, like I was saying, there are reasons to think that core goods inflation might slow down a bit. If I look at services, labor-intensive services, and then I go back to that job market where we have 1.7 job openings for every 1 unemployed individual. We have wage growth, according to the Atlanta Fed wage tracker, that's still running upwards of 6.7% year on year. Average hourly earnings a little bit slower, but still well above levels that would be consistent with 2% inflation. That's where I really worry about persistent inflationary pressure. You'll have some pressure in rents, also in shelter prices. That's basically lagged effects from price increases that we've seen in the past, but really non-shelter services and the tight labor market is where I would be most concerned about persistent inflationary pressure.
Greg, we often talk about the S&P 500 and whether the Federal Reserve has a price target. I wonder if they've got an EPS target. Because right now, you've got the vice chair telling us that there's ample room for margin recompression. Isn't that basically the Fed telling you that earnings in corporate America are going to come down?
Yes, but she's not wrong either, because you're looking at record profit margins, right? Well above anything we've seen on a long-term trend basis. And so there is ample room, right? And so, our expectation is profit margins to come down. I've been saying that for over a decade now. Sure. But from labor cost increases, just input costs generally on the rise, and revenues slated to come down. And keep in mind, Jonathan, that corporates have put on all this low-cost debt. That's a good news, bad news story. The good news is when, the operating leverage is working in your favor, you have ample profits. And when that reverses, it goes the other way. So I think there's more of a downside deceleration or acceleration to the downside than anticipated.
Andrew, just final question from me to you. This 75 basis point hike in November, is that the last one of the cycle?
It may be. And that's where it comes back to, does the Fed get that flexibility from the data? I think if you see margin compression, like you were just talking about, if you see goods inflation that's slowing, if we see a job market that looks like it's showing some signs of loosening, that would give the Fed at least the signs that it needs to see to start that process of slowing down. If you don't see those things, then I think that's the risk. We could get another 75 basis points at subsequent meetings.
I'm sure the market will price a pivot somewhere in between at some point in our future. Andrew, thank you. Andrew Hollenhorst over at Citi, looking for 75 from the Fed next month. That decision will come a week before the midterms. AMH down in D.C. joined us right now. Anne-Marie, talk to us about a month ahead.
Well, we just had some insight last night, Jonathan, about the Senate race in Ohio. This is Senator Portman's seat, and very much this is Ohio that's turned red over the past two elections, the voting for Donald Trump twice. But if you look at what 538 is saying, they're saying that this race is actually getting very, very close. And you had this debate with J.D. Vance and then Congressman Tim Ryan. And Jonathan, the top issues we've seen across the polls really came out in this debate. You had Congressman Ryan talking Vance an extremist. Abortion was one of those issues. And at the same time, you saw the congressman actually say, distancing himself from the White House, saying that President Biden shouldn't run again, said that the vice president was wrong about saying that the southern border was secure. So you see these issues coming up again in a very hotly contested race. That's Ohio, and you're going to see more of these debates to give you an insight of what's going on within the country. I would also like to point to what's going on in Nevada, because there's an issue that is affecting the White House right now, and that's obviously the concern of rising oil prices and what that means for gas prices. And what you see is that potentially Republicans can flip Nevada, and a huge issue there is inflation, and that is gas prices. The national average, Jonathan, for gas prices right now is still under $4 a gallon. It's $3.92 around on average nationally. In Nevada, the average is north of $5 a gallon. This is a key issue when you look at some of these western states.
AMH, we'll catch up again in the next hour. Looking forward to it. Anne-Marie down in Washington, D.C. $3.92, rather, the national average right now, Greg. Are we starting to see the same problems from the summer come back again?
We are. We are, and the timing's really quite poor from the Democrat side. So, higher prices.
Operation Midterms next month. I'm waiting to see what they can do about this one, whether they tap the SPR in a bigger fashion once again. Coming up, Kona Hack, the head of research at EDF Man. Looking forward to that conversation coming up next on the programme, with equity futures down 0.8% on the S&P. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Reports have emerged of Iranian oil workers joining protests, which have continued over the death of a 22-year-old woman last month who was in custody of the so-called morality police. Now, unverified social media videos show dozens of laborers and uniformed workers marching. Israel and Lebanon have reached what's being called an historic agreement to settle their maritime dispute, according to Israeli Prime Minister Yair Lapid's office. In a text message, his office said the deal will, quote, strengthen Israel's security, inject billions into Israel's economy, and ensure the stability of the country's northern border. Malaysia is heading for early elections this year after Prime Minister Ismail Sabri Yaakob announced the dissolution of parliament. His ruling UMNO party is seeking to strengthen its position following a run of successful local polls and a budget for next year that lowers taxes. Now, the leader says the election commission will decide on the date of the vote, which must be held within 60 days. Mercedes-Benz sales rose by more than a fifth during the third quarter, piercing through ongoing supply chain bottlenecks and increasingly negative economic outlook as consumers battle surging inflation. The luxury automaker delivered nearly 518,000 vehicles globally in the third quarter, up 21% compared to the same period a year ago, with demand in China leading strong growth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
If China's on the way back, and if that's a big move in the right direction, we probably will see the market trade towards $100. But I don't see it returning to $130 where it was at the beginning of the Ukraine crisis.
Bob Yorga there, weighing in on the energy situation. The senior strategist at Mizuho Americas, live from New York City this morning. Good morning. Here's the state of play. I'm sure the equity market bulls would love the bond market just to stay closed, but that's not how this works. Yields up again by 6 basis points to 394.49 on a US 10-year. In the equity market, where yields go, you know where the equity market is going. Yields up, stocks down. Equities down by 0.8%. Crude down a little bit, down by 2.4% to 88.94. The theme of the last couple of weeks, though, in the commodity market, we've got a bounce, a rally once again. Kona Hack joins us now, the head of research at ED&F Man. Kona, let's start there. I think a lot of people wanted to park this story as something that happened a year ago, and it's going to start to fade a little bit more. It's back on the agenda. Why?
Yeah, I think, well, why did it start fading? I think that was because the mood of the sentiment basically moved away from inflationary fears, which is very pro-commodities, to recessionary fears, which are anti-commodities. And so I think you started to see a wholesale risk off. The dollar was strong, nobody wanted to invest in commodities. And then last week or so, we started to see partly a retraction in the dollar, but importantly, we started to see an escalation in the Ukrainian war. And I think what that has done is brought back to attention the fact that this powerhouse, which is Ukraine and Russia, they are such a big supplier of food and energy commodities that anything can go wrong overnight. And I think they just realized that actually stocks are not that comfortable across the commodity space. And if you see further supply disruptions from this region, suddenly the supply-demand balances can go outright. And this is when things become a little bit scary again.
Ikona, is this sentiment or something more real? Is there something that you saw take place over the weekend that will actually disrupt supply?
Well, the way the missiles were targeted, it did seem to be that Russia was targeting some of the energy facilities of Ukraine. I think that is a strategic issue, and I think it's worrying because obviously if Ukrainian people then have to flee the country and move to Europe in order to seek energy, they become essentially energy refugees. What we saw in Europe the last year or so, we've been seeing a huge influx of Ukrainian refugees, which have pushed up demand for food. Now we might see the same thing for energy at a time when European energy is really, there's just not enough to go around. So I think that is a key issue. And I think we just know that Europe is so vulnerable right now to any kind of supply disruption out of Russia, and Ukraine is just another one on the top now.
Ikona, based on what you're seeing right now, and I'd love to wrap things up with the following question. Do you see a material risk that these kind of price moves might be stickier than some people think, even in a decelerating economy?
Yes, unfortunately, yes, because although we do have the recessionary fears ahead, And that in itself can lead to demand destruction, not just for energy, but also for certain foods, particularly food price inelastic ones. I think ultimately commodities are staples. You can't do without them. And I think certainly the supply side risks are just too intense right now, particularly as we go into the winter period. And I think it's just entrenched in everything, whether it's food production or manufacturing or transportation. Everything is underlying by how high the energy prices are going to go. So I think inevitably that means it's sticky. You're not going to see prices normalize back to where we were over a year ago. I think that is not going to happen. And certainly as long as supply side risks are elevated, as they seem to be now, I think that is definitely a dead cert.
Connor, thank you. Always good to catch up. Connor Hack there of ED and F-Man on the latest in the commodity market. Some final thoughts now with Greg Peters of PGIM. Greg, first of all, thanks for being with us for an hour.
Thanks for having me.
CPI on Thursday. How sticky is this story going to be? We've talked about peak Fed, then we've had to park that once again. Talked about peak inflation, had to park that about 5 different times in the last 12 months or so. Are we going to make the same mistake again?
I think inflation is incredibly difficult to forecast, to state the obvious. And so I wouldn't be surprised by another misreading. But I think ultimately what we're seeing month after month is a broadening out and a stickiness that we didn't anticipate. And I also think it's important to look at it globally. So this is not just a U.S. issue. This is a global issue. And there's different reasons that's driving it. So I believe that inflation's a little more stickier than what's being forecasted. The forward market is still really quite enthusiastic around inflation coming down. And I think the story, Jonathan, over the next 6 to 9 months is the stickiness of that inflation reading. Even if it does come off the peak, is it really going to be a straight line down to 2% zone?
So we could have 4-5% inflation and be in a recession.
That would be a really bad outcome if you're a central banker, and that's the risk on the table. And so if that's the case, I think central bankers have to lean on it even harder, right? If you throw the economy into a recession and inflation remains high, you fail on both fronts. So to me, that means you don't pause, you actually lean harder into it.
How does the bond market trade in that world?
Poorly. I mean, the worst case scenario for the bond market is stagflation, all financial assets, right? And that's what we're witnessing this year. And so if that's still pervasive into next year, then I think you'll have much of the same story next year as you do this year.
We've gone through a range of markets this morning together, on your screen, on mine, and you've talked a lot about where the opportunities might be. But each and every time you've said not yet. Need to be patient here. What are you waiting for? What specifically are you waiting for? What are the preconditions that you and the team get around the table and think about, and we're just not there yet? What are you waiting for?
Yeah, I mean, look, I am much more enthusiastic around the opportunity set today than I was 6 months ago, 9 months ago, right? If you go back to when the 10-year was at 50 basis points, where was the opportunity going forward, right? It was, well, short, obviously, but you know, we're definitely seeing a lot of value created. We're seeing lots of disruption. And so we are excited about micro parts of the market. So if you look at what's happening with the LDI situation, there's lots of interesting securities for sale at distressed types of prices. Those are the things we're focused on. These broad macro calls just are really difficult normally. They're even more difficult today. So we're seeing lots of value idiosyncratically. You know, we are bond pickers at the end of the day, but I think making a massive call on rates and overall kind of beta market is really difficult.
You know, I'm going to force you to make a massive call on rates right now. If I buy the 10-year here, am I happy I did in 12 months?
Maybe not 12, but 18 to 2 years. Absolutely.
Greg Peters of PGIM. Greg, this was fun.
Thank you. Thanks for having me.
We should kick Tom out again and do this again.
We should. I would be all for that.
Looking forward to it. Bring Mike Collins and the team as well. We'll have a PGIM party or something at 6 a.m. I'm sure you'll all enjoy that. Greg Peters, thank you, sir. Looking forward to seeing you again. Thank you. Mohamed El-Erian's going to join us in the next hour. Looking forward to that. He'll be with us through the next 60 minutes. We'll catch up with a range of guests, including the Deputy Prime Minister of Spain. We'll talk to the Spanish about what they think about a plan that's been circulating around Europe that Germany has kind of pushed back against. Futures are down by about 0.75% on the S&P 500. Where equities are going, you know where yields are. They're up by 6 basis points on a 10-year, 393. 88. Euro-dollar is unchanged at about 97, and crude is lower by 2.4% at $88 and about 97 cents. Heard on radio, seen on TV, this is Bloomberg.
A hard landing is very likely because the labor market has gotten too tight.
This is an environment where the bond market vigilantes are back.
You're seeing spreads stay wide and stay sticky.
The Fed is, with the jobs report, is really indicating that they'll probably continue on hiking in a more aggressive fashion.
I think there's worse to come for the market, unfortunately.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The bond vigilantes are back, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio, alongside Mohammed Al-Arian for the next hour. I'm Jonathan Ferro. Equity futures down 0.7%. Mohammed, this is special. The vigilantes are back in the bond market, and the central banks have got some problems, haven't they?
They have. Not only are they needing to balance growth and inflation, but there's financial stability on top. It's a three-dimensional challenge that is actually very tricky.
Do you think they're going to have to tolerate higher inflation? This will be a thing we talk about through the next 60 minutes, but is that ultimately where this is heading?
Ultimately. Three ultimately's, yes, that's where it's heading, but on the way there, they're going to stick to that 2%.
You talked about that better destination a few times over the last couple of weeks. What is that destination?
First, we exit artificial finance, which has created a lot of damage and which we are going to spend a lot of time trying to overcome. That's really important. We need genuine finance as opposed to artificial finance. And secondly, we're going to focus more than ever on economic growth, and economic growth that's sustainable. That's a better place to be than where we've been.
We'll discuss this with Gagi Chowdhury of BlackRock imminently. Going into that conversation, equity futures look like this on the S&P. We're down 0.6%. This positive correlation between bonds and stocks is not going anywhere. Equities down, treasuries down, yields higher by 5 basis points to 392.86 on a 10-year. Equities lower by 0.6%. Euro-dollar. Euro showing a bit of strength here at 97.19, positive 0.2%, and crude a little bit of weakness at $88.96. We're missing Bramo today. She's over at the Greenwich Economic Forum, and Lisa joins us right now. Morning, Lisa.
Hey, John, and I will just say I couldn't handle the bearishness, so I just decided to take a cruise down the Long Island Sound and contemplate this new regime change and perhaps also the Mets, which I'm not going to be in studio to speak with Mohammed Al-Arian and Saab together about what's going on. We are going to be having some incredible conversations today. You know, we have policymakers meeting in Washington, D.C. to talk about how they are featuring higher inflation, how they're combating that in the face of slowing growth. Here, it's what do you do as an investor? Who is the marginal buyer? We're going to be speaking with Jim Zelter of Apollo. We're also going to be speaking with Lawrence Golub of Golub Capital, Ned Lamont, the Connecticut governor, coming up here. And then later in the day, Ray Dalio, of course, of Bridgewater, the co-chief investment officer, Kathy Wood of ARK Invest, and Kip DeVere of Ares Capital. This question of at what point is this a buy? At what point are we looking at something that actually offers value? If you're a bond vigilante, are you there yet? Are you happy with what you're seeing? And John, it kind of answers the question of, okay, what's the trigger point where we start to realize this new reality and people start to say, yay, we're getting yield again?
Yay, we're getting yield again. Potentially, maybe. Lisa, thank you. Awesome. And let the record show that Lisa brought up the Mets, Mohammed, and I didn't.
I know, but I'm glad she's not here because I do think we would solve together.
You'd commiserate?
Oh, totally. We would make each other cry even more.
You support the Jets, though. She supports the Giants.
I can live with that.
You can live with that.
I can live with that.
Big win over the weekend. You happy with that?
For both teams.
For both teams. The
Right.
Giants, too.
The Giants, too. That came back in a very dramatic fashion.
Against Mr. Rogers, is that right?
Yes.
You're proud of my football knowledge?
I'm very proud of your football knowledge.
Bramo will catch up in the next hour. Looking forward to it. Around the table with Mohammed and I through the next 10 minutes or so. Gagi Chowdhury of BlackRock. Gagi, thank you for coming in. Let's talk about market functioning. Have we got a market functioning problem?
Good morning to both of you. It's great to be here. So, market functioning problem in the US, we haven't really seen it, especially when we compare it to what's happening in the UK. I will say, you know, given my seat and looking at ETFs and looking at iShares trading, we have seen a huge amount of volume in ETF trading. You know, there are days when we get up to about 43% of the equity market trading in ETF. And I think there is something to take away from that, and that means that people are looking for liquidity and going where they can find it. So is there a challenge yet? No. Can there be, especially as we go into year-end with the quantitative tightening in process? There could, for sure, and I think the Fed has to be very cognizant of that.
Where are you anticipating pockets of stress at the moment?
So at the moment, I would say that, for almost all of the year, we have thought about interest rates moving up. And only now are we getting to some levels, especially in the longer end of the curve, so 10s, 15s, 20s, 30s, which may be looking a little bit more interesting to people. So to the extent that a lot of investors come back into the interest rate market, a lot of investors come back into that long end of the curve, and then we see bond outflows. Then we see foreign investors, Japanese investors, sort of flee away from the market because of hedging costs. I think there could be some stress there. I don't actually expect there to be any massive stresses in the front end of the market or even in the credit market, because I think the balance sheets of most of these companies look very good. So staying up in quality makes a lot of sense. And I would also say that, we started talking about liquidity going into year end. I'd be very cautious about how the market trades, keep a strong eye on the repo markets.
But are we looking in the right places? So when I hear you say we're not seeing stress in the ETF space, we're not going to see stress because fundamentals are basically sound for most companies. I agree on both. But that's not where stress originates. Stress tends to originate in the periphery.
Yeah.
It then contaminates technicals. Technicals then cascade through the market. And next thing you know, even markets with strong fundamentals are disrupted. So if you look at the periphery, don't you start seeing serious stress developing there?
Yeah, and I think that's why when I started this conversation, I was like, in the U.S., it's obviously we're in a much better place. I think when we go out to Europe and we are looking at periphery in Europe, I think that could certainly be the case. I think there's a lot of doubts about how they're going to come out of this energy crisis and how they're going to do, especially with interest rates climbing higher. So yes, some stress could occur there. I'll also say that, unfortunately, we're often not able to pinpoint the stress exactly, right? This isn't going to be the housing market stress that we had in the crisis just because it happened the last time. I think there will be new areas of stress in the market. I think one of the things that we'll be looking at is market functioning and how bonds and equities trade between now and the end of the year. And we'll be looking at what it costs to finance things. I think that's what will give us some indications.
So the top question I get asked, and I want to pass it to you, is when we have an inflation concern, when we have a growth concern, and now we have a market, potentially a market function concern, where should we hide? Where do we go? Yeah. How do you get risk mitigation into a portfolio? What do we tell people?
Yeah, it's a good question. And it's been a hard year for market participants, for investors, with bonds not really giving us that ballast. I think the good news, or a little bit of a good news, is that at least the front end of the curve, the closer and closer we get to that 4.5% in the U.S. markets, can potentially be a place to hide. I do think the closer we get with, U.S. 2-year treasuries getting you 4.5%, with front-end IG getting you over 5%, I think those are creating some pockets of opportunities. I'll also say that within the equity markets, there are areas that you're supposed to gravitate towards. And, we've talked about this even since our mid-year in July, where energy markets and energy equities, not so much energy as a commodity, but energy equities, given the balance sheet of the companies, given the cash flow, given the earnings that we're going to see, I think is another area that could potentially do well, could be that reflationary hedge for you. And I would also say that infrastructure, probably, when we think about inflation hedge infrastructure, given the backdrop of potential policy support that's coming its way, could be another. But broadly, would I buy long duration today? Not quite yet. But I think the front end of fixed income markets, high quality fixed income markets, are beginning to look attractive. And the last one, and this is my favorite, I've spent my life looking at inflation-linked bonds, but the very front end, and again, looking at 2 years and shorter, that has cheapened up significantly. Some pressure from UK. I'd say that would make a little bit of sense in portfolios.
You've got some competition from the Bank of England now, because they're going to be buying linkers too. Mohammed, you brought something up that I think is really important for many people. It's been super frustrating, massively frustrating, the positive correlation between equities and bonds. Is it price that changes that story, that we get to a moment in the Treasury market where it just kicks in the other way? Or does something about the environment need to change?
So, John, first, we've had that private correlation for a while, but it worked for us. So when both prices were going up, I didn't hear anybody complaining, right? Why? They were both going up because they were pushed by predictable and massive injection of liquidity. the financial conditions have changed. The liquidity regime has changed. So it's not surprising to me that the correlation, the positive correlation, the unusually historic positive correlation has persisted. Yes, look, at some point I agree with Gagi. The front end is starting to look attractive again. But be careful of technicals. A lot of people underestimate what technicals look like. And when you go to a regime where people are forced to do things, then that changes the market in a significant manner.
Are we in that regime right now?
We're getting close.
Gagi, are we?
I'm not sure yet. I think we learn more between now and the end of the year, and I think the central bank has a big role to play in that.
Do you think this Fed's going to back away anytime soon?
Not this year, but I think next year, yes. I think once they start seeing a couple of prints on CPI, which we haven't even talked about yet, once they see a couple of prints that are away from the 0.5s and 0.6, closer to the 0.3s, and healthcare inflation starts coming down, perhaps rental inflation starts coming down, I think they can start talking about the two-sided nature. We heard that from Lael Brainard yesterday. I think they can start talking about monetary policy works with a lag. So
you
next
teed
year.
up CPI in a couple of days. Final word then, inflation, Thursday.
6.5 on core, 8.1 on headline. Look for services strength and goods weakness. And I would specifically look for services X of shelter to see how that's accelerating or decelerating.
Can I just tell you, so 6.5 on core relative to 6.3, which was the last reading. Where does core peak?
I think around, it's always hard to say that, but I think around here, just around here. So maybe we see another month. I think more importantly, we should look at the month-over-month prints because there's so many funky dynamics, as you know, with the 2020 prints. But I would say that monthly changes probably allow for this to be kind of the peak.
Gagi Chowdhury of BlackRock. Gagi, thank you. The title of your latest piece, The Romance with the Fed Pivot Breaks Investors' Hearts. It's going to break a lot of hearts again, isn't it?
That was last week. Let's hope something else sort of reestablishes another romance.
Mohammed, sticking with us through the next 60 minutes or so. We'll catch up with Michael O'Rourke, Chief Market Strategist at Jones Trading. Looking forward to catching up with him in the next hour as well. We'll touch base with AMH down in DC. Up next from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A group of 7 leaders are scheduled to hold a call today, during which Russia's strikes on civilian targets are set to top the agenda. Russian leader Vladimir Putin has said the fresh assault was a retaliation for explosions on a multi-billion-dollar bridge connecting Russia to Crimea. Now, Ukraine has not claimed responsibility for that incident. Wheat traded near the highest level in more than 3 months as Russian President Vladimir Putin threatened more missile strikes across Ukraine. The escalation has sparked more fears that harvest and transport in the country will be cut even further. The agreement over the Black Sea export corridor comes up for renewal next month. Singapore Airlines says pregnant cabin crew workers can keep their jobs. That reverses long-standing and much criticized rule that they leave the airline. Responding to a Straits Times article on Monday, Singapore Air said pregnant cabin employees may choose to work on ground crews and can resume flying duties after maternity leave. Credit Suisse faces a shortfall of as much as $8 billion in 2024. That's according to Goldman Sachs. It's a further illustration of the troubles facing the Swiss lender. Analysts estimate a hole of at least 4 billion Swiss francs and say an equity raise would be prudent, given the need to restructure the investment banking operations at a time of minimal capital generation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We're starting to see the effect on some sectors, but it's going to take some time for that cumulative tightening to transmit throughout the economy and for inflation to come down. And of course, uncertainty is high, so I'm paying close attention to global risks.
Lael Brainard there, the Federal Reserve Vice Chair at the National Association of Business Economics. Live from New York City this morning. Good morning. Alongside Mohammed Al-Arian for the next hour. Looking forward to our coverage. We'll catch up with the Spanish Deputy Prime Minister a little bit later this hour as well. Futures right now shaping up as follows on the S&P 500. We are lower, negative by 0.6%, just about off the lows. And guess what? Treasury yields just about off the highs. Yields up by 4 basis points on a 10-year, 392.25. The gilt market, Mohammed, in the UK, all over the place. File this under things you never want to say as a central banker. This line here: dysfunction in this market and the prospect of self-reinforcing fire sale dynamics pose a material risk to UK financial stability. They've expanded their support this morning. They still have this line in though. As previously announced, the bank plans to end these operations and cease all gilt purchases on Friday, the 14th of October. That is a couple of days away. Is that doable?
It is doable, but doable in a very challenged environment. What they're trying to do is pass on the liquidity provision to the private market, supported by the Bank of England. That's what they're trying to do. John, I think there are two major takeaways here because they go beyond what's happening in the Bank of England. One is the difficulty of balancing growth, inflation, and financial stability. It is not just a Bank of England issue. You'll see it in the Eurozone, you'll see it in the US. The second issue, which is just as important, is tipping points. Once the bond vigilantes are unleashed, they tend to find tipping points. So central banks and governments have to be very aware that we are getting close to a situation where financial instability is the tail that wags the dog of the economy.
Go through that trilemma again and tell me which one you think we have to accept.
So I think that we need different instruments to deal with different issues. We need the central banks to focus on inflation. We need governments to do more to promote economic growth. And then we need the regulators, because the risk of financial instability is in the non-banks. It's not in the banks, it's in the non-banks. We need the financial regulators to step up to a challenge that they haven't done. Risk doesn't disappear. It morphs and migrates, and it has migrated to the non-banks.
Is that an impossible trinity?
It's a difficult trinity. It's not an impossible trinity, it's a difficult trinity. And the later you leave it, which is why the Fed being so late is problematic, the later you leave it, the harder it gets.
The reason I ask these questions, and I've asked this of Rick Reeder last week, I'd love your insight on this too. Think about what we've just blown up. And I don't think we have enough time to reflect on this. Every given morning we talk about the latest news, the latest data point. We've just blown up a decade of QE, negative rates, zero rates forever. We were sitting here thinking maybe we go through another full cycle with the ECB doing the same thing. And I'm trying to understand whether we fully realise the consequences of that. And we touched on it with Gargi Chowdhury, and Gargi talks about the resilience of balance sheets. And I hear that a lot about public markets, about credit, corporate balance sheets. I hear that a lot about household balance sheets. It's not 2008 again. And you correctly brought up where the risk might lie, and it's on the periphery. Can you give me a little bit more on that? What you think that is?
For the last year, you and I have been talking about that sequence that we didn't want to see happen. It starts with interest rate risks. It's all about central banks changing the liquidity regime. Then it migrates to credit risk. We worry about recession. And then if we're not careful, it migrates to liquidity risk. And we've been talking about be careful of that sequence, because when we get to liquidity risk, all three are playing at the same time. And what we've seen happen, because central banks have been so late, is that that sequence has played out. And we are now dealing with interest rates and credit risk, and we're worried about liquidity risk. That's a really difficult environment, and we have to appreciate that navigating through this is going to be incredibly bumpy.
Market stability is the phrase at the moment.
Market functioning.
And market functioning too. Right. Vladimir Putin of Russia talking about market stability right now. OPEC Plus decisions aimed at ensuring market stability. Goes on to say that OPEC Plus decisions were not aimed at anyone else. Anne-Marie joins us now down in Washington. AMH, your take on those lines?
Well, we've heard this before from the leaders of OPEC countries, but obviously, even if they're not aimed, as President Putin says, towards anyone else, they clearly benefit the producers, especially the likes of Russia, which at the moment is really being hampered on how much they can export, but obviously needs a much higher price. Jonathan, I would say for Putin to make these comments were relatively bland for him on the energy front. You have to look at who he's sitting next to. Right now, he's having a meeting with Sheikh Mohammed bin Zayed, the leader of the UAE, and it's quite uncomfortable for some of these leaders who are trying to act as a mediator and individuals who want to strike a peace deal with this war that's happening, with Putin's invasion of Ukraine. This is something Putin can say alongside MBZ to say that this OPEC decision was really about market stability and not about politics, which many are viewing it as.
And Marie, as you've been widely reporting, this has both domestic implications for the U.S., but it also has implications for U.S. foreign policy. So how do you think the Biden administration responds to what it's seeing?
It's incredibly challenging for the administration right now on two fronts. One, you have, of course, the geopolitics and the politics and the optics of the president making this historic trip to the kingdom. And then just 3 months later and weeks before the midterms, the kingdom not coming to its help in terms of oil supply when clearly they need to keep a lid on gasoline prices. What Jonathan and I spoke about in the last hour is the fact that you look at the national average is below $4 a gallon. But you look at places like Nevada where the Democrats are really trying to keep a hold of that Senate seat, and right now the polls are not showing that may not be possible. You have a gallon of gasoline north of $5 a gallon. That was the peak of the national average in June. Then, Mohammed, you layer on top the conversations that I'm sure you're going to be privy to when you head down to D.C. this week at the IMF, is the price cap. This is something the West wants to see, but we already heard from Russia that if there's a price cap, they may not, it might impact their production and exports, and they say it's going to have a backlash effect. So they might not even want to export if they're being told they have to at a certain price.
AMH, final word. It can be about baseball if you want it to be.
Well, in the commercial break, I think our viewers should just know that postseason baseball, Mohamed El-Arian's on the Yankees train.
I'm not sure he is. I'm not sure he is. Are you?
I am. No, I'd like to see a New York team win.
No way.
Yes.
You're going to root for the Yankees
Heard it here
now.
first.
Yeah.
What kind of Mets fan are you?
I am a realistic one.
Smart one.
AMH down in D.C. Anne-Marie, thank you. Operation Midterms for this White House and the gas price. Mohammed, how problematic is this going to be?
It is problematic. I mean, if this continues in terms of energy prices, and it depends on demand. Demand is giving the administration some relief. But if this continues, headline inflation is going to head back up. And we're going to start having the eights be not just a one-off, but be persistent. And that's a real problem.
Sticky inflation. We've talked about that so much through this year. Do you think the Fed is still a little bit too optimistic about what they can achieve in the next 12 months on this front?
Their projections are optimistic, not just on inflation, but also on growth.
Aspirational. Some have called it. Would you call it aspirational?
That's a nice word, yes.
Aspirational. I feel like you want to talk more about that, but you're hesitating. We're going to build on that in the next segment. We'll do that with Jane Foley, the head of FX strategy at Rabobank. Foreign exchange not doing much this morning. The equity market bouncing off the lows. We're down about 0.5% on the S&P 500. Yields up by 4 or 5 basis points on a 10-year. 392.86. Euro dollar firmer. Stronger euro up 1/3%. Euro dollar 97.32. From New York, this is Bloomberg. Live from New York City this morning. Good morning. 2 hours away from the opening bell. Your equity market shaping up as follows. Off the lows on the S&P, yields off the highs. Equity futures negative 0.5% on the S&P, on the Nasdaq. Down about 0.5% also. Your Treasury market shaping up as follows. On a 10-year, getting closer to 4%, then backing away up 4 or 5 basis points on a session to 392.65. Yields at the front end very close to the highs of the year. The highs we have not seen since 2007. 430.58 on a 2-year. Just about 4.31 on a 2-year yield. Euro dollar problematic yesterday as Italian-German spreads broke through about 250, the wides of the year, backed away in the last 24 hours. Euro dollar 97.32. We are positive there by about 1/3%. Bob Michael at JP Morgan Asset Management has things to say, caught up with the team at Bloomberg. This is what he had to say. When the central bank steps on the brakes, something goes through the windshield. The cost of financing has gone up and it will create tension in the system. Mohammed, you've been talking about this for a long, long time. What's going through the windshield?
So the economy is starting to go through the windshield. The financial system is starting to go through the windshield. This is not stepping on the brakes. This is slamming the brakes. It is the most front-loaded interest rate cycle that we have seen in a very long time. And it didn't need to be this. This is the tragedy of it, John. It didn't need to be this way. This is a self-inflicted wound by central banks.
You're incredibly frustrated with this Fed and the damage it's about to do to this economy.
I am, not just to this economy, but to the rest of the world. And they've been warned over and over and over again, but somehow they held on to this transitory for way too long. Mistake number one. And mistake number two, when they retired that word from the vocabulary, they didn't act. They didn't act in any meaningful way.
300 basis points now in 6 months. Vice Chair Brainerd yesterday went through a long list of things just to convey how much financial conditions have tightened. A 2-year through 4% for the first time since 2007, a 10-year near decade highs on a 10-year yield. Mortgage rates have doubled this year. She talked about the strength of the dollar so far this year as well. Long and variable lags. Can you walk me through long and variable lags? It feels like to me over the last several years we've talked about a Fed and a market that just prices in everything all at once. Click of the fingers, just like that. Do you push back against that?
I do, and I push back also about being overly data dependent, because when you're overly data dependent, you don't look beyond the next corner, and then you get surprised by what you meet. I would suggest to everybody to read Lael Brainerd's speech. That was actually a very balanced speech and a very thought-provoking speech, and probably the best thing that's come out of the Fed for a while in terms of where we are and what to think about going forward.
She reflected on policy trade-offs in that speech. I was reading it again last night, a few hours after she delivered it. What do you think the trade-offs are now for this Fed?
So it is back to the trilemma that we talked about earlier. It is inflation, growth, and financial stability, and they somehow have to find a way through this.
And the spillover, potentially from the rest of the world, is something to consider too.
That they're going to hear about a lot at the annual meetings of the IMF and the World Bank.
We're going to talk about it right now with Jane Foley, the head of FX strategy at Rabobank. Jane, let's start with the Bank of England's additional support earlier today. What did you make of that?
Well, it does seem a little bit desperate, doesn't it? And it does raise the question about what happens at the end of the week if the Bank of England goes ahead and withdraws this support. So we know why the Bank of England have been doing this. Clearly, there's been fairly chaotic moves in the gilts market. And again, yesterday, particularly in the index-linked market, which is why they had to incorporate that into their special measures. But of course, this is just addressing the symptoms, not the cause. And the cause remains that the market is very concerned about what this government is doing on fiscal policy and on spending. And of course, we had those reports today for the Institute of Fiscal Studies saying the government may have to make cuts of, huge cuts, 60 billion or so in spending in order to balance the books. That is going to be extremely painful. And although the Chancellor's brought forward his statement till Halloween about how he's going to balance these books, it's not clear that we can really be convinced that he can really send a reassuring message on that date.
Jane, I won't ask you to guess what will or won't happen on Friday, if it gets removed or if it gets extended. Can we do a bit of scenario analysis, though? Can you tell me about what you think this market would look like in response to a Bank of England that does not extend that gilt market operation?
I think it's going to look pretty horrible if they do not, like I say, because the fundamental problem remains unaddressed, and that's about fiscal spending. So if they don't extend this, if they go ahead and say, we're going to start up quantitative tightening at the end of the month again, it's going to look like a terrible mess. And I think that's something which will again be reflected in the price of the pound as well. If they extend, well, I think there's a lot of pressure for them to do that. You get to the extent where it might be questioning their credibility, but the Bank of England are being very careful in whose bonds they are buying. They're buying smaller amounts because they really are trying to pinpoint that the pension funds are under stress, not buying assets back from everybody. So that's protecting their credibility to some degree. But really, I think the ball has got to be in the government's court, and the government do need to realise that.
Jane, if I may ask you to go from the UK to global. Lots of people will be convening on Washington, D.C. for the annual meetings of the IMF and the World Bank. There's a view out there that the dollar strength is a U.S. problem. It is up to the U.S. to do something about it. The U.S. should perhaps intervene of some sort. Is it really that?
Well, I think the problem is bigger. I mean, you mentioned before, about the global economy going through the windscreen. And I would go even further and say for some economies, they're not only through the windscreen, but they're under the wheels as well on the back of dollar strength. It's clearly providing a huge amount of pain. But the problem is that the Fed have got a domestically focused mandate. They're not mandated as things are to look at the wider economy. And I think we've talked about this on Bloomberg before, about the dollar almost being in this feedback loop, whereas the worse it becomes for the global economy, the more likely people are just to buy the US dollar, which of course makes it worse again for some countries in the global economy. So there does need to be, some sort of outlet for this. And I think that's only going to happen when the Fed decides that, it's done enough to push that inflation genie back in the box, or something gives. But right now, I think there's terrible pressure on the global economy. And the Fed right now appear to just be really quite resistant to that.
So what do you say to people who say it's already given, DXY peaked at 115, we're down to 112, we're going to be going even lower. This is a problem from yesterday. Dollar strength is behind us. Do you really think dollar peak is behind us?
No, not necessarily. And I would say, dollar strength has only peaked, when you can answer the question, well, what else are you going to buy? When you want to buy risky assets, when you want to move into emerging markets, when the fundamentals are there for you to take on that risk, that's when the dollar will have peaked. And I don't think we are there yet. I think, there's so much bad news coming from the global economy that I don't think there is that appetite to sell dollars and buy those riskier currencies just yet.
Dollar cash, Mohammed, it's been the only place to be all year, hasn't it?
It has.
Do you see that improving anytime soon?
So I agree with Jane. I think Jane's absolutely right. But you have to recognize that there's a growing number of people who believe that peak everything is behind us. Peak dollars behind us, peak yields behind us. And we've heard it over and over again. I don't agree, but the view is out there.
You're going to these IMF meetings a little bit later this week. Do you think we could even come up with the kind of coordination that is required to do something about this, even if we wanted to?
No, this is not April 2009. Multilateral governance is really challenged. I think we're going to talk about the problems. There's going to be socialization that this is a global issue. It's not a UK issue, it's not a US, it's global. I love the way Jane said that it's not just that people have gone through the windscreen, but certain developing countries are under the wheels. Yeah. And she's absolutely right. And that's going to be expressed very loudly. The problem, as she points out, is it's difficult to do something about.
There's one central bank that's sitting this whole thing out, Jane. It's the Bank of Japan. I'd love a final word on that. The JGB 10-year didn't trade today for a third straight session for the first time since 1999. We don't even have a market there anymore, and I think we should stop calling it one. Jane, I want to understand from your perspective what this BOJ looks like after Kuroda.
I would say that right now, the Bank of Japan understood that when the Ministry of Finance a few weeks ago ordered that intervention, they understood it was just buying time. The dollar yen has been trending higher still since the intervention. They know that that's going to be the case because of the interest rate differentials. But they know as soon as the Ministry of Finance starts talking about verbal intervention again, they will then be forced to do something about it at some point. So they're waiting, they're watching. But I think dollar yen is still biased to go higher as long as the Bank of Japan is on its policy course, which of course is one of wanting to nurture inflation, so different from the rest of the G10.
Jane Foley of Rabobank out of London. Jane, thank you very much. What do you make of that? There's two ways of looking at this. I was perhaps a little bit mean earlier this year, and I said the BOJ is like the ostrich with the head in the sand, pretending nothing is going on around it when everyone else is hiking interest rates. There is another way of looking at this. It's much kinder. It's that the BOJ sees this as a once-in-a-lifetime opportunity to reset inflation expectations in Japan. Which one is it?
I think it's more the former than the latter. I think they are in a cognitive trap that they're not able to get out of. It is meaningful when you say the government bond market hasn't traded in 3 days.
It's ridiculous.
Right. I mean, how unthinkable is that statement? The government bond market,
sure,
which is at the center of all other markets.
Well, you've talked about that transition then. How hard is it to transition away from what we've witnessed in the last couple of decades to a market, to some people coming in a market and trying to price risk again?
I go back to the image of a very bumpy journey to a better destination. You've got to navigate both the journey and the destination.
Well, let's talk about a bump, and I think it's a massive pothole. What happens if yield curve control gets abandoned in Japan? Right now, a 10-year at 25 basis points. Is that a problem for them or a problem for us, the rest of the world?
It's mainly a problem for them. I mean, because the rest of the world has repriced. It is the outlier. And think of a ball underwater and suddenly you release it. It will overshoot.
It's going to go like a rocket.
Right.
We mentioned the IMF meetings a few times. How gloomy do you think these are going to be?
They're going to be gloomy. Because there's also geopolitical risk on top of that. There's the whole challenge on climate. We mustn't forget that. So this is going to be a reminder a little bit of October 2008, when people gather in Washington and realize we have a global problem that needs a global solution.
And yet still we're not forecasting recessions at the Fed, not forecasting a recession at the ECB.
You call it aspirational?
Do you call it aspirational? We had someone write in on Twitter that said you wanted to say it was delusional, but you checked yourself. Is it delusional or aspirational?
Must be someone that I know.
Mohammed El-Erian sticking with us. We'll continue this conversation on Europe in just a moment. Nadia Calvino, the Deputy Prime Minister of Spain, joining us very, very shortly from New York City this morning. Good morning. Futures lower. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Reports have emerged of Iranian oil workers joining protests, which have continued over the death of a 22-year-old woman last month who was in the custody of the so-called morality police. Now, unverified social media videos show dozens of laborers and uniformed workers marching. A renewed push for Scottish independence is set to force its way onto UK Prime Minister Liz Truss's agenda. The debate over a second referendum on Scotland breaking with the rest of the UK goes to the Supreme Court in London today. Truss's Conservatives, who are in opposition in Scotland, accuse the Scottish National Party government of pursuing a, quote, self-serving, obsessive push. Mercedes-Benz sales rose by more than a fifth during the third quarter, piercing through ongoing supply chain bottlenecks and an increasingly negative economic outlook as consumers battle surging inflation. The luxury automaker delivered nearly 518,000 vehicles globally in the third quarter, up 21% compared to the same period a year ago, with demand in China leading strong growth. More allegations in the Elon Musk and Twitter battle. Bloomberg has learned that just before the billionaire revived his proposal to buy the social media company, he accused Twitter of ordering a whistleblower to destroy evidence. And according to court filings, Peter Zatko says that he burned 10 handwritten notebooks and deleted 100 computer files at the request of managers as part of a $7.8 million severance package. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Inflation in Europe is not essentially domestically driven. And we have an ECB which is forced into tightening to keep inflation expectations anchored in a situation of massively adverse supply side shock. It's not an easy thing to explain.
It's a difficult moment in Europe. I've said that so many times in the last 9 months or so. Gilles Mowick there, the chief economist at AXA Investment Managers. Going into the opening bell in New York City, stateside, we shape up as follows on the S&P. Off-session lows on the S&P 500, negative 0.6%. Yields off-session highs, still higher though on the day by 4 basis points. 392.45 on a 10-year. Euro dollar 97.23. Mohammed, I can't get used to that. 97.23 on euro dollar. We're positive about 0.2%. Lucky this morning, not just because we have Mohammed Al-Arian around the table with us, but also because we're joined by Nadia Calvino, the Deputy Prime Minister of Spain. Madam Vice President, fantastic to have you with us in the building.
Thanks for having me.
Let's start here. The prospect of joint debt to do something about the energy crisis in Europe. Is that something you think we can find agreement on at the European level?
Well, when we were hit by the pandemic, Europe reacted in a very decisive manner on the basis of unity and solidarity. I think that now, this time around, that we're faced with global challenges again, a war at the doorstep of Europe, we should react with the same principles. Whether that entails additional debt issuance or not, we will see. But in any case, we should act, together in a decisive manner to tackle these challenges.
Based on preliminary discussions with, say, the Germans, have they conveyed to you that that's something they would support?
We had the bilateral summit between Spain and Germany this last week, and we had an exchange with the ministers, also with the Chancellor Scholz. He was one of the persons that was behind the issuance of joint debt to address and to tackle the challenges from the pandemic. We didn't go into the details, but I am quite sure that Germany is aware of the need to react in a manner which makes us stronger and allows us to face the current challenges in the best possible manner for our populations too.
Your Excellency, there is a market consensus developing that this is going to be a very difficult winter for Europe, a winter that may see Europe fall into recession. What's not clear is the length and depth of this potential recession. Do we have any indicators of what happens if indeed Europe falls into recession this winter?
Well, I think what will happen will depend on what we do. That is something I think we have learned in the last 3 years. So I am not really deterministic in the sense of this is what's going to happen. We need to now take the right decisions to avoid this situation arising. We're meeting this week in the World Bank and IMF annual meetings. This is a very challenging and delicate point in time. The global economy is slowing down. Inflation is increasing in some Western economies. But I hope that we are able to make the right decisions to avoid these scenarios to arise in practice.
And what do we say to people who say the initial conditions are such that there's almost no policy flexibility? The ECB has to address inflation. Fiscal space is limited, and if you go too far, the bond vigilantes may come in. Just look at what has happened to the UK. And the reality is that even if governments wish to move, the amount of measures available to them is much more limited than in the past.
It is indeed tricky. It's not easy to articulate economic policy these days. I think that one basic principle is a good coordination of monetary and fiscal policy. From the perspective of Spain, just to give you an example, we're very strongly committed to pursuing the path of deficit and debt reduction. And I think that is going along and helping monetary policy implementation in the EU. I do hope that we find the right balance, between fighting inflation and not endangering growth, because if we want to pursue also fiscal responsibility, growth and job creation is a necessary function for it to be sustainable.
Well, let's talk about the growth forecasts from both the Bank of Spain and from the Spanish government. The Bank of Spain, I understand, for 2023 is at 1.4%. Your government's at 2.1%. Do you think that articulates to the Spanish people just how much pain this economy is about to go through? One thing that's been thrown at this Federal Reserve is that their forecasts have been unrealistic, that they've been too aspirational. Is that realistic or aspirational?
No, it's realistic, absolutely. We had very strong growth in 2021, around 5.5%. We're having very strong growth in 2022, around 4.4%, and that's a quite prudent forecast. And what we anticipate is a slowdown of growth in 2023. Obviously, the European economy is very much affected by what happens in Germany, so it would be unrealistic, not to think that there will be a slowdown. But all institutions, national, public, private, international, they foresee the Spanish economy to continue to grow in 2023. And there are some elements that make it particularly resilient and strong at this point in time.
Whether it's the Fed's aggressive interest rates hiking cycle or the strength of the dollar, there's a perception that a lot of people are going to be going to Washington and talking to the American authorities and saying, what you do here has major repercussion, not just for Europe, but beyond that, especially in the developing world. And U.S., you must have a global perspective. Do you think that's even a realistic conversation to have in Washington, D.C. these days?
I do think they are well aware of the impact of their decisions throughout the world. Just like Putin's actions in Ukraine are having a worldwide impact, which is not only having to do with security, defense, not only having to do with inflation, also food security is a key issue that we will certainly be talking about in the course of this week. I do think that the U.S. authorities are well aware of the impact of their decisions on emerging economies and on inflation throughout the world and growth throughout the world, of course.
Do you think they should step back from this tightening cycle?
Well, I would never dare to say anything to a monetary policy authority. I hope that they will get it right, both in the US and in Europe. The sources of inflation are very different on both sides of the Atlantic. It's a demand-driven as well as supply-driven inflation in the case of the US. It is really a supply-side shock. You were talking about it just a moment ago. It's energy prices going up is the underlying cause of inflation in the EU. That would call for a differentiated monetary policy. But as you were rightly saying, interest exchange rates are very, very sensitive and very important in this regard. And so that is driving the relationship between monetary policy in different parts of the world. I really hope they get it right.
How gloomy is this going to be in a couple of days down in Washington? How depressing is this meeting going to be?
Well, I think that we're quite used to tackling and dealing with crisis. Since you were referring to 2007, 2008, sure. I was already around at the time dealing with financial regulation. I think, ever since, we haven't really left a very complex scenario where multiple interrelationships are hitting each other and having an effect, So I think that it's good we have the G20. It's good that we're meeting this week. And I hope we do have a good outcome in terms of articulation of a good economic policy at this point in time.
Let's do that again soon. Diplomatic, as I would expect. Thank you. Nadia Calvino, the Deputy Prime Minister of Spain. Vice President, thank you. Mohammed, fantastic to have you with us for an hour. What a difficult moment. You know what Rick Reeder said on Friday? That he hadn't seen a market like this in his lifetime. Have you?
Not this difficult. Not this difficult.
This is tough, right?
This is very tough.
It seems like every week is exhausting.
But it's even tougher for the policymakers.
I couldn't agree more. particularly the ones sitting alongside us, going through the rest of this year. Again, Nadia, thank you. Vice President, thank you very much. Mohammed, thank you, sir. What a privilege. We're going to do this again?
I hope so.
Do you like the 7 a.m. slot? Would you prefer 8 o'clock, 9?
I'm in your hands.
We can make some changes
I'm in
for
your
next
hands.
time. From New York City this morning, good morning. Futures lower by 0.5%. We'll catch up with Bramo in the next hour. She's got some fantastic guests lined up for you. Live from New York, this is Bloomberg.
Powell has now endorsed the notion that there is going to be some pain involved.
I don't think they will bring QT to an end early.
The market is coming to terms with the idea that rates are going to go higher, and they're going to stay there for longer as well.
In a world of broadly bearish outlook for risk assets across the board, relative shelter is in the front end of the investment grade curve.
The next thing to really worry about is the CPI.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, flying solo through the next couple of hours, I'm Jonathan Ferro. TK will be down in DC for the IMF meetings later on this week. We'll catch up with Lisa in just a moment. Coming up later this week, not just the IMF meetings, CPI on Thursday and bank earnings coming up on Friday with JP Morgan kicking things off for you. In the market right now, this morning, we are lower by about 0.4% on the S&P 500. Yields are higher by 3 basis points, 391.43 on a 10-year. Yields off session highs, equities off session lows, but the direction very familiar for you. Yields up, stocks down. Elsewhere in the FX market, euro-dollar 97.26. We're positive by 0.2%. The euro showing just a little bit of strength. And after a monster rally last week in the commodity market, WTI $89.43. We're down there by 1.9%. I'm pleased to say, not flying completely solo, because Lisa joins us now from the Greenwich Economic Forum. And Lisa, in the next hour, a ton of fantastic guests coming right up.
We do, and I would never abandon you, honestly, as much as it is gorgeous here, and I'm traveling down the Long Island Sound and trying to investigate the mood for alternative investors globally. I'm also thinking about you and your fabulous conversations with Mohammed Al-Arian in the prior hour. Coming up, we have a series of incredible guests, including Ned Lamont, the governor of Connecticut, at a time of such flux. I mean, I really can't emphasize enough in terms of both taxes, in terms of heading into a more tumultuous economic time, and also given the fact that there have been so many people who have come here post-pandemic. Jim Zelter, Apollo Global co-president. How do you invest as someone who focuses on private markets when suddenly public markets look pretty good? And Lawrence Golub of Golub Capital, also focused in this area. This is really a day, you've talked about this a lot, John, of bond vigilantes. So where does the marginal buyer come from, and where do they focus? Of course, we're also going to be hearing from Ray Dalio today of Bridgewater. He's going to be speaking with our own David Weston. We're also going to be hearing from Kathy Wood of ARK Invest. And then we're also going to be hearing from Kip DeVere of Ares Capital. So many conversations, John, as we deal with the policy changes that we're going to be hearing about from Washington, D.C. with Tom down there. Here, it's about who is going to step up and what kind of yield they're going to be looking for.
Elisa, one thing we used to say when you get into a crisis, markets can stop panicking when policymakers start to panic. We just talked about the IMF meetings in the last couple of hours, what's going to take place later this week. We had the Spanish Deputy Prime Minister reflect on the gloom that she might have to come up against. Mohammed talked about maybe the idea that this reminds him of, say, 2008, not because he thinks 2008 and what happened then is going to transpire now, but ultimately because it feels like that kind of moment, feels big, important. Lisa, I've been missing your thoughts on that all morning. What's your take on that conversation?
Well, have we heard that from policymakers in the United States? Have we heard that from the Fed? The concern here is in 2008, we did not see inflation like this. We did not see that kind of focus. So what's going to take for them to pull back from some of the rate hiking? And what we've heard from Lael Brainard, what we've heard from pretty much everyone, Charlie Evans, really is this other discussion around getting rates up high and then leaving them there for a longer period of time. This is not the crisis kind of move that you're looking for if you're an investor. This is going to inflict pain. So, you know, they're not necessarily panicking. Maybe in the United Kingdom they are, but elsewhere they're not, which is the reason why those bond vigilantes can come out with a vengeance.
Lisa, thank you. Looking forward to the conversations. later this hour. Lisa Abramowicz there from the Greenwich Economic Forum. Bob Michael of JP Morgan Asset Management speaking to our colleagues here at Bloomberg. This is what he had to say. When the central bank steps on the brakes, something goes through the windshield. The cost of financing has gone up and it will create tension in the system. I read that quote out in the last hour and Mohammed responded to it. Take a listen to what Mohammed had to say.
The economy is starting to go through the windshield. The financial system is starting to go through the windshield. This is not stepping on the brakes. This is slamming the brakes. It is the most front-loaded interest rate cycle that we have seen in a very long time. And it didn't need to be this. This is the tragedy of it, John. It didn't need to be this way. This is a self-inflicted wound by central banks.
The brilliant Mohammed Al-Arian in the previous hour. We're joined now by the brilliant Michael O'Rourke, Chief Market Strategist at Jones Trading. Michael, let's start there. How bad is this going to be?
I tend to agree with Mohammed. From his, the perspective he gave, the Fed, if they acted earlier, they could have stopped earlier, and instead inflation got out of control, and now they need to really get it under control, which is going to be a process. And I think that's the issue the market's having right now, is we're in this visibility vacuum that people don't know what to do. And we're not going to have a typical V bottom that markets have come to expect. So it's just this uncertainty just keeps weighing on investors.
Michael, is there a pocket of the market as you look cross-asset, across a range of securities, where we haven't adequately discounted some of the economic pain that might be in our future?
Oh, I think the equity market is that spot. I think Jamie Dimon was spot on saying that we could easily go down another 20%. If you go down 10%, you're looking at the S&P 500 trailing PE will just be at the historic average at that point. And there's a very strong case to be made with all the stimulus, financial monetary stimulus in 2021. Last year's earnings were some type of peak. So we have to start discounting weaker earnings going forward in the future just because of the interest rate environment. So I would say it's fair to say we could have that next 20% down, and then we still have to evaluate where are we and what's business going to look like in an interest rate environment with a Fed funds rate above 4%.
Let's just sit on rates a little bit longer. You mentioned that Jamie Dimon conversation with Juliana over at CNBC. This is what he said on rates, Michael, that caught my eye. Rates going up another 100 basis points is a lot more painful than the first 100 basis points because people aren't used to it. Michael, did that resonate with you? What is it about the next 100 basis points that's harder than the previous 300?
Well, it's funny. If you look at the consumer credit data we received on Friday, you'll see that consumers are borrowing at a tremendous pace this year. So, consumer credit's up. The monthly borrow is up 50% versus last year, and then it's about 100% against pre-pandemic years. So you're talking about people haven't adjusted to the higher interest rate. They're using their credit cards, they're using borrowing to kind of fill the holes right now. But as this process plays out and we're dealing with these higher interest rates, they're going to start retrenching as we head into year end and as we head into 2023. And then it's funny, that circles back to the comments that Mohammed was making, that it's going to be slamming the brakes on. It's just taking a little time. They have their credit cards, they have their borrowing, providing that little bit of a lifeline between now and then.
And Michael, the longer variable lags of monetary policy, how much tightening is already in the pipeline that we've yet to fully realise the consequences of? Michael, I asked this question delicately and perhaps provocatively, but you can push back by all means. Do you think a recession is all but guaranteed based on what they've already done?
I don't think it's all but guaranteed based on what they've done. I do fear, I'm a person who would prefer to see the Fed be a little tighter, a little more hawkish, traditionally. I do think this latest forecast they gave is very aggressive. It's more aggressive than I would be. I think the pause level should be somewhere around 4% of the Fed funds rate. So we're not there yet. And again, but if they raise to the point of where their target is, I think that's going to bring a recession on. And that gives me a lot of concern going forward.
Michael, can you get bullish about the prospect of a pause from this Fed?
I can get bullish about the prospect of a pause, but we're still not anything near attractive valuations for the environment we're in. I mean, when you think about all these developments that are going on, like these China chip sanctions, and it's a different environment than we experienced for the past decade. For the past 2 decades, we've had this low inflation environment due to globalization, and China being the manufacturing center for the world, exporting low inflation. Obviously, that's shifting today. So we're heading into a new higher, not high inflation regime, but higher inflation regime. So we need to have positive real interest, a positive real Fed funds rate, which we haven't had since the global financial crisis. And that's just a tougher growth environment, but that's where the Fed needs to head. And I think that's where we are heading. And I think that changes the investment outlook for everybody. It's going to be a much different environment going forward than we've seen for the past 10 or 12 years.
People just aren't used to this at all. Michael, Bank of America came out with their outlook for earnings, and there was a quote from them that I pulled from Savita and the team. Consensus feedback from clients. Third quarter might hold up, but who cares? Guidance is going to be terrible. We expect a slight 1% miss in 3Q, but big downside risk starting in 4Q. Michael, do you agree with that assessment?
I do. I think what's happened here is there's been this visibility vacuum. So analysts haven't had good guidance to go off of as far as projecting where trends in business are. I think we're going to see that with this earnings season. But the problem is, where we start out, this is a process that's going to take time to play out. And that's what's wearing on markets. So we still won't have great visibility about 2023 because, again, this interest rate environment, it's a generational tightening we're seeing. And, as Mohammed said, we're slamming the brakes on. So the environment's going to look very different 2023 as far as the business environment. So you still can't have high confidence in the earnings estimates, still can't have high confidence in the numbers. And that just demands a higher risk premium for investors to want to take a position in a stock.
Michael, final question. You sound like a man hiding in cash. Is there anywhere else to weather the storm?
You know what? I think the most attractive out there right now is the 2-year Treasury note. I think that's incorporated all the Fed hikes that we should need in there. I think it's very much priced in. They're yielding, 4.25, 4.3%. I think that's a good place to be. If the Fed does have to, pause earlier, I think they'll respond well. So that's the asset I like. I do like the financial sector. I like the banks. But again, I think there should be much better opportunities in the equities landscape in 2023.
We'll hear from the banks on Friday. Michael, enjoyed it. It's good to catch up, buddy. Michael O'Rourke there of Jones Trading. Thank you, sir. Futures recovering just a little bit. We're down about 0.25% on the S&P. On the other side of the break, we'll be catching up with Lisa Abramowicz alongside Governor Ned Lamont, the Democrat from Connecticut. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A group of 7 leaders are scheduled to hold a call today during which Russia's strikes on civilian targets are set to top the agenda. Russian leader Vladimir Putin has said the fresh assault was a retaliation for explosions on a multi-billion-dollar bridge connecting Russia to Crimea. Ukraine has not claimed responsibility for that incident. Afghanistan's Taliban-led government is working to build closer trade ties with Russia as it looks to import fuel and wheat before winter sets in, according to a top official. Now, Afghanistan's Minister of Commerce and Industry says a Moscow offer of food grains and fuel at a discounted rate made the deal appealing. Ties between Moscow and Afghanistan have grown following the U.S. exit last year. Credit Suisse faces a shortfall of as much as $8 billion in 2024, according to Goldman Sachs. It's a further illustration of the troubles facing the Swiss lender. Analysts estimate a hole of at least 4 billion Swiss francs and say an equity raise would be prudent given the need to restructure the investment banking operations at a time of minimal capital generation. French Finance Minister Bruno Le Maire called on Total Energies and unions to bring an end to a pay dispute that has seen workers block the country's biggest oil refineries, causing shortages at gas stations. In an interview with France Info Radio Today, Le Maire said, quote, "Our fellow citizens can't be the collateral victims of the labor conflict." Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
It's been slow to tighten, and you have to do a lot to catch up. If you do a lot to catch up, you may not notice that you've done more than that's actually sufficient. I think hard landing is very likely because the labor market has gotten too tight. The Fed needs to push the unemployment rate up significantly, and that's likely to lead to a recession.
Always good, always great to catch up with Bill Dudley, Bloomberg opinion columnist and former New York Fed president, live from New York City this morning. Good morning. Equities recovering, staging a recovery in the last couple of hours or so. We're down now by only 0.25% on the S&P over the previous 4 days. 4 days of losses on the S&P 500. Over that period, down about 4.71%. On the S&P. Yields backing away from session highs as well, no doubt helping out that equity market. The bond market now yields higher by just a single basis point on the 10-year, 389.80. That's the market action. Let's head over to the Greenwich Economic Forum where we can catch up with Lisa. Hey, Lisa.
Hey, John, we're live from Connecticut, from Greenwich, Connecticut, sitting in front of the Long Island Sound. And here with us, we have Ned Lamont, the Democratic governor from Connecticut, who has been in office since 2019. Thank you so much for joining us. And there are a lot of people who live here. It was really easy for them to come to this conference, many of them who lived in New York City prior to the pandemic, many people who have come, including businesses. How do you, as the governor, plan to keep them, considering the pull, the allure of low-tax states?
I think we have one of the great education systems in the country. So a lot of people want to come here for their families to start things up. Stanford, Greenwich has become a real financial center, fintech center, you know, cryptocurrency, financial services. Obviously, we've got the insurance capital of the world. So there's a great ecosystem and base for finance. And I think we've had a lot of finance companies come up to Connecticut over the last few years.
And we've noticed that, right, with all of them moving their headquarters to both Connecticut and also to Florida because it's a low-tax state. You're running against Bob Stefanowski, and there are about 30 days left in this election cycle. He's been espousing lowering taxes. You've previously raised taxes. How do you sort of speak to this issue, given that you talk about the education system, you talk about some of the services that cost money?
Well, to be exact, we inherited a $2 billion budget deficit as far as the eye could see, and we balanced that by holding the line on spending. It was the first governor in 30 years not to raise income taxes. And this last year, we put in place the biggest middle-class tax cut there is, but making life a little more affordable in this inflationary time. But bigger, you're right. I've got in place a rainy day fund. I'm going to hear from the finance people here today. Whether I'm erring on the side of caution, I hope I am, but I'm going to be ready.
You said that you're going to be listening to Ray Dalio talk about how the world's about to implode, and then you're going to sit there and hide under your chair as you try to prepare your budget. How do you plan to really withstand whatever is to come, given the negativity out there and given that it is hard to borrow right now with rates where they are?
Well, two things. I've got 15% of our budget set aside in cash. We call it the rainy day fund. So if capital gains start slipping, which it already has, you know, we'll be ready. I don't have to raise taxes. I don't have to cut education, you know, funding going forward. I budgeted very conservative for this fiscal year. I think we could see sort of the storm clouds out there. I assumed we were going to have less revenues this year already. So I think we're ready for what may be coming.
I go back to the election cycle because this is the midterm election cycle, as I'm sure you are more aware of than anybody else. And Bob Stefanowski, your opponent, does keep talking about the importance of keeping some of the businesses here to keep the revenues. How do you balance lowering taxes to be competitive with states that have really drawn a lot of Wall Street businesses with needing the money to actually make the state livable?
Look, we had a couple of Fortune 500 companies move into the state. We had dozens of other companies. But, Lisa, more importantly, a lot of our local companies are growing and expanding big time. We had more new business startups than ever before. You know, I've often said I don't want more taxes, but I don't mind more taxpayers. Our economic pie is growing, and that's why we have a surplus.
So your tone has shifted a little bit in the election cycle, with more focus on just get out and vote. Why is there the emphasis on getting people to vote? Do you think that there is something that will keep Democrats home?
I think anger sometimes motivates people. I'm more optimistic. I believe in the state. I got to make people believe we're turning things around. We're making progress every day. And I don't want people to be complacent. I want you to have a stake in this election. So, yeah, vote.
All right. So going forward, how concerned are you about some of the businesses that have been leaving, given the low tax issue and given the fact that some of the revenues are going to be strained for possibly years if what Ray Dalio says comes to pass?
I think a lot of the companies that are coming to Connecticut and staying in Connecticut, respect tax stability. They know that for the first time in years we have not raised taxes. That makes a big deal. But it's bigger than that. Again, they love the best education system in the country. They love the fact that we provide job training so they'll get the people they need and the skills they need.
Do you feel like there's a shift right now? And we talk about this all the time on Bloomberg Surveillance, about how there is constraint on the fiscal response to crises at this moment. Because when you're dealing with inflation, you're dealing with a situation where you cannot borrow money in the same kind of way. How are you preparing for that with the lack of ability to plug gaps with simply selling bonds?
Hey, look, there's a big macroeconomic world out there, and we're a small piece of it. We get buffeted by international and national things. All I can do is prepare. And I prepared by, making sure we have a lot of dry powder, as I suggested before, billions of dollars set aside. I can't go out and borrow my way out of this. Maybe that's a little game they play in Washington. You can't do that at the state level.
And when you look out today and you hear all of these executives of major alternative investment firms, many of which, including Apollo, we're going to be speaking with Apollo coming up, have moved recently to Connecticut. What are you listening to? What have you heard from them that you find most compelling to sort of shape your narrative going forward?
I think they like being here. They don't necessarily have to be in New York City or Boston, depending, 5 days a week. Maybe it's 1 or 2 days a week. Otherwise, I think they like the lifestyle here. They like the ecosystem. They like the fact that we have a very well-trained, smart, educated workforce. It helps them grow and expand right here.
Do you have more tax hikes planned for anyone? I know that there were tax hikes overall, perhaps not for the middle class, but overall there were some tax hikes that you did with your first budget. Do you plan on doing that again, or was that a one-time thing?
No, we didn't do that. As I said, I was the first guy not to raise the income tax, on anybody. And we're not doing that. People want tax stability. They want to say, what's the state not only look like now, but what's it going to look like in 5 years so they can plan accordingly. Look, I come out of the business world. I need to know what the world's going to look like in a few years so I can put together my projections and make them happen.
Why are you a Yankees fan?
They like to win.
Hey, blow after
Sorry
the Mets
about that,
losing.
Lisa.
And we are looking at a situation after the Mets going on, and you've been trying to encourage Stevie Cohen, who is also a resident of your state, to buy your local team. Is that correct?
Yeah, we have the Yard Goats. It's an amazing minor league baseball team up in Hartford.
Yeah.
And I'd often thought, boy, if you want to get a foothold here bigger in Connecticut, buy the Yard Goats and make them a Mets franchise.
So that's your pitch to him?
That's my pitch.
So give us the inside scoop. Is he going to buy?
I think he plays his cards pretty close to the vest.
I think so, too. Ned Lamont, thank you so much for being with us.
Thanks,
Ned
Lisa.
Lamont, Governor of Connecticut, here with us in Greenwich. Coming up, we're going to be speaking with Jim Zelter of Apollo Global Management as we take a look at the scene forward at a time of incredible tumult. And then next, later in this week, we're going to be heading to the IMF, where Tom Keene will be interviewing the policymakers trying to navigate what is going to be a very difficult moment as bond vigilantes rear their heads. From New York, this is Bloomberg.
Around about 60 minutes away from the opening bell, live from New York City this morning. Good morning on TV and radio. This is Bloomberg Surveillance. Equity futures recovering on the S&P 500. Just about unchanged now on the S&P. As session lows down by more than 1%. Helped out by a bond market with yields no longer at session highs. The high of this morning on a 10-year through 4% briefly. It was up 12 basis points. Now up not even 2 to 389.80. That's the price action. Let's head back over to Greenwich, Connecticut to catch up with Lisa Abramowicz. Hey, Lisa.
Hey, John. So right now we're talking all morning about the bond vigilantes. And right now we have someone who has been in the bond market for decades, Jim Zelter, co-president of Apollo Global, who has really helped found the entire credit business, which now has more than $350 billion of assets under management. And as John's been talking about all morning, this was the day of bond vigilantes. This is the year of bond vigilantes, and this is raising so much fear among people who have gotten used to zero rates over such a long period of time. Are you more nervous today or more excited?
Well, you got to respect it. First of all, nice to be here this morning. Certainly there's a big paradigm shift going on right now, and you have to respect the markets. As you said, the bond vigilantes, they'll get rates where they should be, more so than the Fed or the central banks. But it's an interesting paradigm shift where you see where rates have been, and we've been in this period where There's been an undue focus on low rates, and it's put valuations very, very high. So it's a period of transition. You have to respect it, but also you want to be on your front foot, which we've been able to do over the last several months, and we'll continue to do so.
What does that mean?
Well, what it really means is if you've been prudent the last decade and not been over your skis in valuations and have been thoughtful about what you put on the books, there's a very interesting time. The cost of capital now matters, purchase price matters, and those who have capital and have a lot of flexibility in their toolbox, you will find many interesting companies from which to give capital to.
Are you taking more risk right now or less risk than you were a month ago?
You know, we're measured. We run a very, very large platform, as you said, over $550 billion in aggregate, over almost $400 billion in debt. You really can't pick the bottom. It's really impossible to predict. You can prepare along the way, but we are methodically putting opportunities to work. We've been active in the CLO market. We've been active in working with some of the banks on the large stock syndications, Citrix in particular. So, you know, I think I have a healthy respect for what's going on, but I don't think we are in the corner cowering by any means.
I love the sanitized language that you're using, and then I think about some of the stories that we've written, including you're talking about CLOs. We've worked with banks. We've helped them. You made incredible amounts of money, especially recently with UK CLOs in the wake of some of the volatility. With Citrix, the banks that are all with all of these hung bridge loans, right? Commitments that they made to finance mergers and acquisitions that are perhaps not priced the way that they were at the time of commitment. How many opportunities do you have to go in and buy some of these assets for the banks?
Well, if you just put today in context with a decade or so ago, in the GFC, the banks were arguably long 500+ billion of loans in high yield. Today, that number is circa 80 to 100 billion. So it's a much smaller opportunity set and much fewer, you know, not as many names. So we have a constant dialogue. We're a very active trader with the banks. You know, no permanent friends, no permanent enemies. You know, we act very, very in great dialogue with them. But on certain names, we will partner in many regions, especially in the U.S. and Europe, with the large banks.
Are they willing to sell?
Well, I think it's you have to have a realistic dialogue, and it's a challenging position. I think they want to move on. They want to get back in business. I mean, the reality is the high yield financing markets are arguably shut down right now. And I think that they would like to be in a position to be able to make new loans at appropriate levels and get paid fairly for those. So it's going to be an interesting period of transition between now and the end of the year.
Traditionally, alternative asset managers, including Apollo, have liked investing in credit that is not traded very often, right? You invest in a company, you get more control, you also have higher yield. Is that the same now, or do you find more opportunities in the public credit markets, given that yields are now north of 10% in many cases, and arguably north of 8% even for pretty high-rated credits?
Well, there's a lot you brought up there. You know, in our credit business, we are really a performing investor. We're looking to extend capital to companies that are growing and get paid back. So there's not really a distressed angle in our typical credit business. As you raised, there are, when you have the dislocation we've had thus far, there are opportunities in the public markets, in the investment grade market, with low dollar price, long duration assets, pretty interesting opportunities. In the private markets, you know, new capital is coming with better terms and better pricing. So you're at this unique period right now where there's actually opportunities in the higher end of both of those markets. It's interesting. High yield on a yield basis is somewhat attractive. On a spread basis, it's sort of historical levels. You know, the spreads this morning are mid 500s, approaching 600. That's typically a time when you get interested in high yield. Right now, the yields are approaching 10%, which is a very attractive number. So, you know, it's my view that, you know, having done this for a few decades now, things are happening faster and faster and faster. The rate rise in the U.S. and globally in the last, 6 months has been historic in not only the speed which it's happened, but also the amount. And in the past, that might have happened over 12, 18, 24 months. So it's my suspicion that by the time we really are officially in a recession in 23 or 24, the opportunity to buy paper some of it will have evaporated. So you have to be measured and patient along the way.
Do you think we're going to see a default cycle akin to what we saw in 2008 or even some of the prior ones in the early 2000s?
Yes, you will see some degree of a default cycle. You can't slow down the economy with the brakes that the monetary policy is leading to today without expecting some accidents. It's going to happen. Resi mortgages have gone from the low to mid 2s to north of 6%. There's going to be a default cycle. It may not be as pervasive, it may not be as wide and deep, but there will be some companies, and also not only the amount of debt, but the actual interest costs have increased dramatically on a floating rate basis.
What's more attractive to you at this point? Looking for those idiosyncratic companies where you want to invest in, or investing in niche investors, that actually going to other asset managers and saying, we'll give you money, we'll give you a stake in our assets, and go at it?
Well, my answer is obviously both. You're alluding to our recent announcements in Diameter, in Sofinova, in Haveli. These are all great managers that have proven their wisdom and their judgment over time in their strategies. We're providing capital for them to grow. At the same time, we're very active on our own accounts. So, we have a large platform. We're connected to a lot of folks. But I think from us, you'll see a strategy of being able to do both of those in concert.
You mentioned CLOs, and I mentioned the United Kingdom. I know that has been a public issue in terms of how much money you made buying CLOs at the right time and then seeing a policy response from the Bank of England. How much are you playing in the UK market right now?
Well, I think from our perspective, the UK market, it is a robust economy going through some great challenges. And, we were very active in post the GFC in the resi marketplace over there. I suspect in the residential market and the commercial real estate market, you'll see us active over the next couple of years as they go through their challenges in the economy. It's early. Really our activity in the CLO market was really U.S. and broadly Europe, with some in the U.K. But as you said earlier, like the CLO market right now, if you look at the most senior tranches, it's a pretty draconian assumption. They're assuming 10+% defaults for the next 5 years, which we think in some cases is an opportunity to be a buyer.
And is in Europe a similar story kind of taking place, or is that?
Yes, I mean, in my view, Europe is a bit behind the U.S. in terms of it's always a bit tighter when the market's tight, and it accentuates the wides in periods of volatility. So there's plenty for us to focus on right now in the U.S. I think Europe and the U.K. will be a 23 and 24 opportunity set. But certainly the U.S. is our primary focus right now.
When we talk about investing alongside some smaller niche investors, do you have any interest in a big European bank that might be going through some distress, that might be splitting up certain aspects of its business? Would you ever be interested in acquiring certain aspects of that business?
Well, as I said, since 08-09, there's been many instances in 2012 and 2015 where we had strategies that really partnered with the banks or were an off-tank for the banks, whether it was credit card subsidiaries in Spain and Ireland, whether it was real estate portfolios in Germany and in the UK. We were always there as a partner, just like we were in 08 and 09 for the US bank. So if there's a global bank and they are considering large-scale strategic transactions, we certainly expect to be part of those dialogues.
How much does your base case include 4 to 4.5% Fed funds rates for perhaps a year or even 2?
I think that's got to be the base case. We're in a higher rate regime that has shocked the system, and the monetary policy makers are trying to really shock the economy on this nasty concept of inflation. So you have to expect we're in a higher rate period for some period of time. We're not macro investors. You got plenty of other folks that can come up here and talk to you, but we're certainly in a higher rate regime for some period of time.
And that's definitely shaping this view in terms of what's required in terms of payment from a lot of these companies. Jim Zelter, thank you so much for taking the time.
Always a pleasure.
Co-president of Apollo Global. Really great to get some perspective, John, here as we freeze outside because it is really cold suddenly.
Bramo, stay warm. Stay warm. Lisa, great work. as always. Lisa Abramowicz, thank you. Making a case that maybe we should have the studio in Greenwich, Connecticut, so that everyone can just walk around the corner from their home and join us on set. Lisa's going to be joining us a little bit later with more guests. Looking forward to that in the next hour. Counting you down to the opening bell, we'll be catching up with Mike Wilson, the chief US equity strategist at Morgan Stanley. With equities recovering this morning on the S&P 500, down but only by 0.1%. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukraine's allies say they will support it for as long as it takes, despite Russia's recent steps to escalate its war there. That's what the group of 7 major industrialized nations plan to say in a statement later today. Now, in a draft statement obtained by Bloomberg, the group says, quote, "We will continue to provide financial, humanitarian, military, diplomatic, and legal support and stand firmly with Ukraine for as long as it takes." A G7 video conference is taking place one day after Russia launched missile strikes in Kyiv and other cities. Israel and Lebanon have reached what's being called an historic agreement to settle their maritime dispute, according to Israeli Prime Minister Yair Lapid's office. Now, in a text message, his office said the deal, quote, "will strengthen Israel's security, inject billions into Israel's economy, and ensure the stability of the country's northern border." A renewed push for Scottish independence is set to force its way onto UK Prime Minister Liz Truss's agenda. The debate over a second referendum on Scotland breaking with the rest of the UK goes to the Supreme Court in London today. Truss's Conservatives, who are in opposition in Scotland, accuse the Scottish National Party government of pursuing a, quote, "self-serving, obsessive push." Mercedes-Benz sales rose by more than a fifth during the third quarter, piercing through ongoing supply chain bottlenecks and an increasingly negative economic outlook as consumers battle surging inflation. The luxury automaker delivered nearly 518,000 vehicles globally in the third quarter. That's up 21% compared to the same period a year ago, with demand in China leading strong growth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The market is coming to terms with the idea that rates are going to go higher, and they're going to stay there for longer as well. The bit that the market is still playing around with is this recession. You know, a lot of people still thinking that soft landing is possible. We think it's very unlikely. And with recession, unfortunately, does come earnings recession.
Seema Shah, global strategist at Principal Asset Management, brilliant yesterday, talking about why she is just as gloomy as sometimes we get accused of being. Sometimes, maybe, not always. None of her gloomy. Michael McKee, he is in Washington right now for all of the meetings down there, although I suspect it is somewhat gloomy there. Bloomberg Economics and Policy correspondent. Mike, what's coming up this week? Can you give us a sense of just what the mood is over there with the International Monetary Fund, as well as the IIF, as well as the World Bank?
You know, Lisa, it's interesting to remember that this is the first time in 3 years now that all of these people have gathered in person in Washington for these meetings. So there's a sense of happiness at that, but there's a real pervasive sense of gloom around the global economy. The IIF, Institute for International Finance, is a group representing the world's biggest banks, and they gather economists and political leaders and investors from around the world, bankers. They're having a conference the first 4 days of this week, and everybody there is basically suggesting that you got to batten down the hatches, that things are not going to be good, that 2023 looks rather bad. The Fed minutes come out tomorrow from the last meeting. There'll be a lot of focus on that to see what they think about how long they're going to have to keep raising rates. And then, of course, that whole idea of the Fed raising rates and the world raising rates is going to be sort of topic one, along with Ukraine, at the IMF World Bank meetings, because the higher the central banks around the world take interest rates, the more it squeezes those who are not prepared. The emerging markets are hanging in, but they have a lot of dollar debt, and the dollar, of course, keeps getting stronger and stronger.
We've heard from a lot of central bankers. We've heard from a lot of Fed members. Some people would argue too much. But for weeks, there was an apparent singing from the same hymn sheet, right? There was a feeling that all of the Fed members were on the same page. And over the past, 24, 48 hours, we heard from Lael Brainerd and a few others who had a slightly different tone. They seemed to emphasize the necessity to not over-tighten, to not make a policy error on the other side. Do you think that's significant, or is this just basically emphasizing something they've been saying all along?
It's basically something they've been saying all along, but I think they're emphasizing it now because we are getting closer to the terminal rate, the rate at which they want to stop, and they do want to get there, and they don't want pressure from the markets. And they don't want the markets to price in too far as well. So they're letting people know, yes, we are aware of your concerns. We're aware of the possibility we could go too far. And so we aren't going to do that. We're going to stop when we need to stop. But they still, according to their latest forecasts, are 125 basis points below that. So some combination of 75, 25, or 50-50 at the next two meetings is probably still to be expected.
Given this backdrop, how important, Mike, is what we're going to see on Thursday?
Well, Thursday is going to be very important because the CPI is going to come out. And I would argue that it's going to be more important for the markets than it is for the Fed because the markets are so jittery about inflation. If it comes in worse than expected, well, that's not going to change the Fed's view that they're going to go 75 basis points. But if it comes in worse than expected, it may change the market's view of where the terminal rate is going to be, how much higher the Fed will have to go. And that could cause some real problems. Now, so far, as Fed Governor Christopher Waller noted this week, the markets are functioning fine in the United States. Can't say that about every market. But it could raise questions about at what point does something break. So there's a lot riding on what the CPI comes out with on Thursday morning.
Okay, so very much to that point, we were hearing earlier, John and Mohamed El-Erian were talking about how, as an investor, you can start getting excited when policymakers panic. They do not seem panicked yet. If anything, they seem panicked about inflation, which is the wrong kind of panic that some of these investors would like to see. What will be the trigger, especially if you have CPI still coming in strong, if you still have this feeling of inflation? Is there a sense of what breakage would actually get Fed officials' attention in some sort of responsive way?
Well, there's an old saying that a recession on Wall Street is when your trade loses money. So the Fed is aware that they're going to get a lot of complaints from investors about their policies because it makes it harder for them to make money. What they're going to be watching for is whether you can trade. Now, we've seen in England over the last couple of days, a couple of weeks, that there are trades that maybe don't go through because you get into this doom loop of margin calls and depressed prices. But so far, that's not happening in the United States. That's what they would watch for. The problem is that they're not going to be problems in the banks. They're going to be in the shadow financial sector. Banks are pretty well capitalized and much heavier scrutinized these days. But you don't know what you don't know is going on in the shadow sector, which is the position that the Bank of England found itself in. And so that's what people are going to be worried about. But the Fed is, at this point, very aware of that possibility. Not sure they can do much about it except to keep vigilant.
Mike, I'm glad that you brought up the United Kingdom. We saw the second intervention in 24 hours from the Bank of England, as it is very clear that the pension problem has not gone away there. There is this inability to trade, but it raises this question about how balance sheets of central banks will be used at a time when many of them would like to see quantitative tightening, not quantitative easing. How much have you heard from U.S. central bankers that they are taking a look at the balance sheet roll-off and that perhaps it will not be watching paint dry?
Well, so far, their view is that it is still watching paint dry, that it's working fine. Christopher Waller summed up kind of the overall view of the Fed this week when he said, look, the markets are giving the Fed back $2 trillion every day in the reverse repo facility. So there is plenty of liquidity out there. It's not a liquidity problem. It's a question of who has the liquidity. Banks don't want more securities, so they're not putting money up to the Fed. And so there may be some regulatory issues that the Fed could address, like the supplementary leverage ratio, that could ease that a little bit. But beyond that, they don't think there's a problem yet with the balance sheet and its size. They're going to keep going with that for now. You don't want to get into a position, as you mentioned, with the Bank of England, where they have two monetary policies working at cross purposes to each other.
You mentioned earlier, Mike, that tomorrow we get some of the meeting minutes from the Federal Reserve. What will be important to look for, especially given all the communication that we get every day?
Well, I think the two things people on Wall Street are going to be looking for is certainly some sort of indication of where they're going to stop and when they're going to stop. If there's a view on that, about how far they can go, how much concern do members have about over-tightening? That's going to be one of the questions that people ask. And the other is going to be, what does the Fed think about how long they want to keep interest rates up? What is their view of inflation? We got their views on where they think inflation is going to be in the summary of economic projections, but what do they really think about how fast it can come down?
Michael McKee, thank you so much. Coming up, we do have that panel with David Weston in conversation with Ray Dalio of Bridgewater, and coming up on Bloomberg TV and radio, Adam Posen, president of the Peterson Institute. This is Bloomberg.